Welcome to the deep dive. Today, we're opening up a really fascinating stack of sources. We're comparing those highly paid professional stock managers against, well, the everyday investor.
And it's centered around this one portfolio that seems almost too good to be true.
Exactly, because the numbers, frankly, they don't make sense on the surface.
They really don't. We keep hearing you need experts, right? But
Yeah, darn
our
well.
sources, they show that something like, 75% of large mutual funds actually fail to do as well as just the basic stock market averages?
75%.
Yeah.
These are people with fancy degrees, complex computer models.
MBAs, the works. And yet average beats them consistently. It's kind of wild.
So why? That's the big question.
Yeah.
Is it maybe the complexity itself? Are they making it complicated just to justify their fees?
Could be. Our sources suggest that maybe this complexity pushed out the regular person, the amateur stock picker.
Yeah, leaving, folks who either treat it like casino money or if they're wealthy, just buy whatever catches their eye.
But what if there's a simpler way, a more successful way? The material we have says yes.
And it points us straight to something called the miracle of St. Agnes.
This is a great story. We're talking Arlington, Massachusetts. Back in 1990, a group of seventh graders.
Seventh graders.
Yeah.
And they managed a model stock portfolio with their teacher, Joan Morrissey.
Right. And this wasn't just pretend. The performance was tracked, and it's pretty stunning.
Stunning is definitely the word. Okay, get this. 2 years, January 90 to December 91, their return was 69.6%.
69.6.
Compare that to the S&P 500 over the exact same time, it returned only 26.08%.
So they didn't just squeak by, they absolutely crushed it. Beat 99% of the professional equity funds out there.
But hang on, was this just luck? Like a random bull market bounce?
Well, that's what you'd think, but the strategy suggests otherwise. The teacher, Miss Morrissey, she had this rule, Peter's principle, #3 as she called it.
Okay.
Never invest in any idea you can't illustrate with a crayon.
Huh. Crayon logic. I like it. So no complicated derivatives or anything.
No, none of that. They picked companies they actually understood from their own lives. They saw everyone shopping at Walmart, so they picked Walmart.
Makes sense.
They saw what kids thought was cool, Nike, Gap, they picked those. It was about what they could see and touch, really.
So focusing on what's popular on Main Street, not necessarily Wall Street. Like the Pentex example, the pen company.
Exactly. Pentex markers and pens were everywhere in classrooms. Ubiquitous. They chose it for that reason, not because some analyst recommended it.
It wasn't a hot stock. It was just a useful product they knew.
Right. And this crayon logic, it also showed up something interesting about the pros. The one real dud in the kids' portfolio. IBM.
Oh, what did it return?
A measly 3.6%. And IBM was exactly the kind of stock professional managers often held onto forever, almost sentimentally.
That inertia trap. Holding on to losers because you don't want to admit the mistake. The kids didn't have that baggage.
Nope. They just looked at what made sense.
Okay, so St. Agnes is amazing, but is it just one amazing class? Or does this simplicity thing have legs?
It seems to. Our sources point to the NAIC, the National Association of Investors Corporation.
The investment clubs, right?
Yeah, thousands of them, like 10,000 clubs. And through the 1980s, their track record was fantastic. They consistently beat the S&P 500.
Wow. And they beat most of the pros, too.
They beat 3/4 of all the equity mutual funds. Again, regular people in clubs beating the experts.
For what was their secret? Was it better stock picks?
Not necessarily superior knowledge, no. It was more about discipline. The clubs have a regular schedule for investing. Like every month, put money in.
So it takes the emotion out. Prevents panic selling or, chasing hot tips.
Exactly. It forces consistency. It stops you from trying to time the market, which almost nobody does well, professionals included.
Yeah.
It's systematized common sense.
Which sounds a lot like what the St. Agnes kids learned. They had their own rules, didn't they, the St. Agnes course?
Yeah, they boiled it down. Things like, you have to diversify. Don't put all your eggs in one basket.
Makes sense.
Do your homework before you invest. Understand the company.
The crayon logic again.
Right. Invest in several stocks, not just one or two. And know that, you can make money, but you can also lose it. Be realistic.
So when you tie it all together, the kids, the clubs, the big message seems pretty clear, doesn't it?
It really does. It suggests that maybe actually understanding the business you're investing in and sticking to simple, disciplined rules.
Well, that's more valuable than all the complex theories and MBA jargon.
It's an applied knowledge over abstract analysis.
You got it. Knowing the business cold seems to beat trying to predict the unpredictable.
So the takeaway for you listening, maybe it's about questioning complexity. If sticking to simple products you understand can actually outperform these high-paid experts.
Experts charging hefty fees, mind you.
Right. Then where else in life might you be overcomplicating things? Where else are you paying for jargon when maybe some basic crayon logic would work better?
Mm, that's definitely something to think about. When is simple actually smarter?
Okay, so today we're doing a deep dive into something a lot of us feel, right? That weekend warrior thing, where you spend all Saturday reading scary headlines and then you're just dreading the market opening on Monday. Our mission today is really to figure out how to swap that fear for, well, for financial discipline.
Exactly. We've looked at insights from some uh, top financial minds, historical data too, and the bottom line, it seems pretty clear. Making money isn't always about being the smartest person in the room. It's also just about not getting spooked out of your positions.
Hmm.
You really need a strong stomach for it because, without that discipline, all the research you do, it's almost useless.
Right. Okay, let's dig into that. A great example of this expert level anxiety is the Barron's Roundtable. It's this annual meeting, right? Where huge names gather: Peter Lynch, John Neff, and Mario Gabelli, big hitters. But you'd think if they're that smart, shouldn't they be kind of, above the panic?
You'd think so.
Yeah.
But it's fascinating how much caution, even pessimism, you can see there sometimes. We saw transcripts where managers were pretty openly worried, like Michael Price and Oscar Schaefer. They actually said something like 45 to 55% of their own funds were in stocks they thought were, quote, unreal.
Unreal. Okay, just so we're clear, when they say unreal there, they mean the price is way too high, not justified.
Precisely. Yeah, totally overvalued in their eyes, like
Yeah.
seeing bubbles forming. And then there was John Neff. He actually joked about inventing a recession. Just because the market had a small dip at the start of a quarter, it really shows that mood.
Wow. So that professional worry, it's kind of like a magnified version of what you might feel Sunday night reading about, I don't know, global cooling scares or geopolitical stuff.
Exactly. And that dread, that external news stuff, it directly feeds into bad decisions internally.
How so? What does that look like?
Well, the sources call it the Dr. Feel-Good method of investing. It's pretty simple, actually. You feel great, you feel confident enough to buy only when the market jumps, say, 600 points, but then it drops 600 points and you feel sick, you panic, you want to sell everything. You're just riding these waves of emotion, chasing the highs, running from the lows. It's the exact opposite of discipline.
Okay, so we need to move away from the feeling and look at the facts. What's the historical data, the sort of antidote to that emotional roller coaster?
Yeah, the facts are really your best shield here. Look, over the last 70 years or so, think about everything that's happened. Wars, recessions, all kinds of global crises. Despite all that, stocks have given owners, on average, an 11% return per year. But you only really capture that return if you stick to your plan, stay disciplined, and try to ignore the day-to-day noise.
That 11%, that's the payoff for basically keeping your cool. But it feels
Yeah.
like people do panic. If drops are normal, why are we so scared of them?
Well, I think people just forget, or maybe they don't realize how normal drops really are. They're not bugs. They're features, you could say. Over those same 70 years, the market had 40 pretty scary drops. We're talking 10% or more. And get this, 13 of those were big ones, like 33% or more down.
Right.
They happen.
Hmm. It's easy to just remember the really traumatic ones, like the '87 crash, right? Black Monday, the Dow dropping 508 points in one day. I mean, imagine seeing that unfold. But like you said, the market survived. It even recovered fairly quickly, didn't it?
It did. And that's really the key point for you listening. We all remember 1929, the Great Crash. It's like the ultimate financial nightmare. But some experts, looking back, they actually point to a different crash, one that's less famous, maybe underpublicized, 1972. They felt that for investors at that specific time, it was almost as devastating.
Really? What happened then?
Well, you had stocks and companies everyone thought were fantastic, solid businesses. Taco Bell was one example they gave. It went from $15 a share down to like $1. Imagine holding that, just wiped out.
Wow, 15 to $1. That's brutal. Absolutely gut-wrenching if that was your money.
Right. But here's the thing. Even though it felt like the end of the world for those investors, it didn't trigger a massive economic depression like 1929 did. It just shows how much perspective matters. How severe an event feels at the time versus its long-term impact. It's a reminder for you that even really painful corrections, ones we might even forget about later, they don't necessarily dictate the whole economy's future, just your immediate anxiety level.
Okay, let's unpack this. We're diving into modern investing. It feels like it should be simpler, but honestly, it's gotten really, really complicated.
It really has. I mean, Our sources point out mutual funds were meant to make stock picking easier, right?
Right.
But the choice just exploded. You look at the numbers, like just over 450 funds back in '76.
Yeah.
By 1990, it was well over 3,500.
Mm-hmm.
That's a lot.
Whoa. Okay, so that sheer volume, that's the big hurdle for you, the listener.
Exactly. So our mission today is pretty focused. Cut through all that noise. We
Mm.
need to find the most effective portfolio strategy based on this analysis anyway, so you can make those allocation decisions quickly, confidently.
Okay, let's talk fear. Because the moment people get nervous or maybe they hit retirement age, the instinct is bonds, safety.
The safe option.
Mm.
But if you look historically, that safety, well, it comes at a huge opportunity cost, a really huge one.
The numbers are pretty stark, aren't they?
They are. Over like a 70-year average, stocks gave you 10.3% a year.
Yeah.
Long-term government bonds,
Yeah.
barely 4.8%.
Less than.
Yeah. And what's really tricky and often missed is inflation. The perception of bond safety. It can be a bit of an illusion.
How so?
Well, think about someone relying on that income, say someone who's 62. If you're loaded up on low-interest bonds or CDs,
You think you're safe.
you think you are, but inflation eats away at what that income can actually buy. Your purchasing power is drastically reduced. Your nominal wealth might hold steady, but your actual standard of living, it's shrinking.
That difference, nominal versus real returns, that's absolutely critical.
It is.
The analysis had a really clear example, didn't it? Over 20 years, $10,000 invested.
Right. Case A, 100% bonds, you get maybe $14,000 in income, plus your original 10 grand back.
Okay.
But case B, just a simple 50-50 stock bond mix. Your total wealth ends up being almost $22,000.
Wow, big difference.
It really shows the compounding power you give up, just for that feeling of short-term comfort.
Okay, but here's where it gets really interesting. What if you went, well, more aggressive, skipped bonds altogether even if you needed income?
Ah, the 100% stocks case study? Yeah, that one's eye-opening.
So the setup was start with $100,000, take out $7,000 a year for income.
And reinvest the dividend, which they pegged at about 3%.
And the result?
The quantitative evidence here is it's overwhelmingly persuasive for the long haul. After 20 years, even pulling out that income every single year, that portfolio grew to an amazing $349,149.
$349,000
That money,
taking income.
Yep. It just proves that stock's long-term historical edge tends to absorb that short-term choppiness, while still providing growth.
Okay, but hang on. For someone actually living off that money, what about the panic? The market tanks 25%. That's when real people sell. How do the sources address that?
That's the million-dollar question, isn't it? The real-world fear.
Yeah.
The analysis argues that, well, even after a big 25% hit like that, the stock portfolio's higher starting point, its superior growth baseline, means it's positioned to recover and still vastly outperform the bond portfolio over time.
So the bond portfolio is actually riskier long-term.
In a way, yes. Especially if you hit a long recession. That 100% bond portfolio might just end up being worth your original $100,000 after 20 years.
Yeah.
So that fear of short-term dips, it could seriously cost you your long-term stability.
Okay, so that leads us somewhere interesting. If stocks are the way, do we pay the experts, the fund managers, to pick them for us?
Ah, the fund manager paradox. It feels intuitive, right? Paying someone good to pick good stocks.
Yeah, makes sense.
But the data, well, it pretty consistently says that active management, it's largely kind of pointless. Most managers just can't beat the market average.
Why not?
Two big headwinds. First, the market's pretty efficient. It's hard to find consistent edges. And second, critically, their fees. Management fees are a constant drag that most just can't overcome year after year.
Right, the fees chip away at returns. And this isn't new, is it? The sources had older data showing this?
Exactly. Timeless principle. Even back in the 80s and 90s, index funds were showing their strength, like data from 83 to 92. The S&P 500 index beat the average actively managed fund in 8 out of those 10 years.
8 out of 10, okay.
And there's concrete proof of the cost. $100,000 invested in 83 in the Vanguard S&P 500 index fund. By 93, it was over $308,000.
Right.
The average managed fund only grew to about $236,000.
Wow, that's, what, nearly $70,000 difference?
Almost 70 grand just left on the table. Oof. Gone to pay someone to underperform the simple index. It's why the sources conclude, basically, that trying to pick tomorrow's winner based on yesterday's performance, it's difficult, maybe even futile.
Okay, so let's boil this down. What does all this data actually mean for you, the listener? What's the actionable takeaway?
It points towards aggressive simplification, really. Invest heavily in stock index funds. That seems clear.
Right.
If you need income, maybe consider using dividend-paying stocks directly rather than funds to control that. And avoid bond funds.
Avoid the funds. Why?
Fees again. If you need bonds for some reason, the analysis suggests just buying treasury bonds directly cuts out that middleman fee.
Makes sense. And for the stock funds, don't try to guess the next hot sector.
Exactly. Don't chase trends. Better to just divide your money across maybe 3 or 4 broad types of stock funds. Think growth, value, maybe some emerging growth. Just spread it out. That way you've always got skin in the game across different parts of the market.
Good advice. Diversify simply. Okay, final thought then. Something provocative for you to chew on.
Oh.
Remember the Japanese stock market, late 1980s? U.S. investors were piling in, even when PE ratios hit 50,
Yeah.
100. Some even hit 200.
Yeah, crazy valuations. Just briefly, for listeners, a PE of 200 means?
It means you're paying $200 for every $1 of that company's earning.
Right, which screams overvaluation. Suggests, future returns are likely to be disappointing.
Exactly. So here's the question it raises. When does that enthusiasm, that excitement for a certain asset class cross the line and become, well, an expensive habit that history tells us usually ends in tears? Welcome to the deep dive. When we think about massive financial success, it's easy to picture this really smooth ride up, right?
Yeah, but that's often not the case.
Exactly. So today we're diving into the early years of the legendary Magellan Fund, the late 60s to 70s, to sort of understand how its incredible success was actually forged when the market was pretty hostile.
Yeah, and that's a crucial distinction for you to grasp. I mean, we all remember Magellan as this behemoth.
Right, the giant.
Exactly. But he was really born struggling, right in the middle of the stock market doldrums, as they call them. Our mission today really is to show you that the biggest returns, they often start far, far away from the spotlight on Wall Street.
Okay, so let's unpack that. First surprise maybe for some listeners, the fund didn't even start as Magellan.
No, that's right. It actually originated back in 1963. It was called the Fidelity International Fund.
International. But wasn't it mostly U.S. stocks later?
Well, yeah, it shifted focus pretty quickly and got renamed Magellan in '65. But get this, it initially targeted domestic stocks in disguise. There's some complicated foreign tax issues involved.
Huh. Okay, so domestic in disguise. But those tax issues were probably the least of their worries back then.
Oh, absolutely. The 1970 stock market was, well, it was an awful place to be. The sources we looked at describe Wall Street as being completely shunned. Just tons of pessimism, really exaggerated fear among investors.
It sounds like a full-blown crisis for the fund itself. I read the assets just plummeted, right? From like $20 million down to only $6 million by 76.
Yeah, steady redemptions. People were just pulling their money out. It was, literally approaching a near-death experience for the fund.
So how did it even survive that?
It got so critical, actually, that Fidelity had to resort to, well, basically pure financial engineering just to save the fund.
Okay, what did they do?
Well, they merged Magellan with another fund, the Essex Fund. And the whole reason, to use Essex's massive $50 million tax loss carry forward.
Ah, the tax angle. So using past losses to offset future gains. Clever.
Exactly. Save them a ton on taxes down the road.
Yeah.
It was purely about survival at that point.
So that need for survival kind of forced their hand. And the sources mention that from 77 to 81, the fund was actually closed to new money.
Yeah, 4 years. Close to new customers, couldn't even sell shares.
And the manager apparently saw this period of obscurity as, what, a blessing and a curse? How much of an edge was that, being forced into isolation like that?
A huge one, arguably. It basically allowed him to really hone his investment strategy without, the public breathing down his neck.
Right, less pressure.
Way less pressure. And his strategy was described as entirely empirical. He wasn't just following the Wall Street herd.
So what did that mean, empirical? What was he looking for?
He really focused on 3, let's call them non-consensus categories. First, small or medium-sized growth companies. Second, firms that were maybe out of favor but showing signs of improving prospects. And third, those really depressed, cyclical stocks or just plain undervalued companies nobody wanted.
And that focus on the overlooked, the stuff Wall Street was ignoring, that's where he found the real monsters.
Absolutely. The home runs. Often completely outside the big blue chip names everyone knew. We're talking Congolium that went up 51 times. And then the really legendary one, Home Depot.
Home Depot is incredible. What's the story there?
Well, what's fascinating is just the sheer scale of the returns you could find in these overlooked smaller stocks back then. He bought Home Depot, the stock, at 25 cents a share. Pre-split, of course.
25 cents.
Yeah. And the sources point out it went on to become a stunning 260 bagger. That's 260 times your initial investment.
That's just mind-boggling. And his research, it wasn't just spreadsheets, right? It was famously unorthodox.
Definitely. I mean, he found Home Depot by literally visiting the store and being impressed.
Yeah.
And the sources mentioned he bought Taco Bell partly because, well, he just really liked their tasty tacos.
Seriously, tasty tacos was part of the due diligence.
You laugh, but that kind of grassroots consumer check was actually fundamental to his empirical approach. If the product was working on the ground, if people liked it, he figured the financials would follow, whether Wall Street saw it yet or not.
Makes sense.
And that same mentality, that boots-on-the-ground view, also led him to spot an opportunity in regional banks around 1980.
Okay, so the big institutional money, they were all focused on the big, supposedly safe money center banks.
Pretty much, yeah. They completely overlooked these regional players, and these regionals were trading at really low price-to-earnings ratios, PE ratios.
Meaning they were cheap compared to their profit.
Exactly. Super cheap. He realized that these local banks, they actually had pretty sound fundamentals. Wall Street just wasn't interested.
And did that pay off too?
Oh, big time. First Atlanta, for example, that was a 30-bagger for him. And he bought others too, like Norwest, Wachovia, NBD Bancorp, names that became much bigger later.
Okay, so stepping back, what's the big takeaway here for you, the listener?
Well, the central insight isn't just, oh, he bought small stocks. It's really about the competitive advantage you can gain by doing fundamental, maybe even non-traditional research away from the crowd, away from the consensus.
Building where others aren't.
Precisely. The really high returns often come from those secondary stocks or whole sectors like the regional banks back then that the institutional experts are actively ignoring or maybe even disliking.
Right. Which I guess raises a really important question for today, doesn't it? If he found a 260 bagger in like a hardware store and huge returns in ignored regional banks, what industries or companies today are similarly ignored, maybe disliked, or just sort of trading quietly in the background but have solid fundamentals?
Yeah, that's the challenge for you, isn't it? Something to think about. Where might tomorrow's 50 bagger or maybe even another 260 bagger be hiding right now? Completely off Wall Street's radar. That's the field of research. Welcome to the Deep Dive. Today, we're really digging into the source material on one of the greats, the Magellan Fund, during its, let's call them, middle years.
Right. We're looking at the playbook, the daily grind, and that, well, pretty hardcore contrarian thinking that really powered its early success.
And that daily grind, it wasn't what you might expect, was it? The hook for me was the starting time.
Oh, yeah. If you're picturing slick terminals and frantic calls right away, nope, think again. The sources describe this incredible intensity, but also a surprising simplicity.
Simplicity how?
Well, the day started at 6:05 a.m. sharp, every day.
6:05.
Yeah. And the tools, an old Rolodex, a sharp comet calculator, this is all before he even looked at the Quotron terminal.
The Quotron, right? The ticker machine from way back. So very low-tech start.
Extremely. And for a long time, it was basically a one-man show.
Which leads to this this paradox we found. He's working these crazy long hours, 6 a.m. start. But the actual trading, buying and selling stocks.
Took less than an hour a day, often much less.
That seems counterintuitive. Yeah. Where did all the time go then?
It went into research. Primary research. He figured out his edge wasn't in rapid trading. It was in, deeply understanding the companies.
So reading reports, talking to management, that kind of thing.
Exactly. Reading annual reports cover to cover, scribbling notes in these binders after every single company contact. It was about deliberately tuning out the market noise.
Okay, so that intense focus, that independent work.
Yeah.
How did that scale? Because eventually it wasn't just a one-man show. He started working with partners, right? Around 81.
Right. The sources call them the not-so-silent partners. And scaling that personal accountability, that was tricky.
Because usually analysts might, play it safe, recommend the big names.
Precisely. The standard Wall Street pressure is towards consensus. Recommend IBM, something safe. But the culture they fostered at Fidelity, specifically for Magellan then, was revolutionary. Fund managers had to do their own independent research. They were completely accountable. Analysts were actually encouraged to disagree, to ignore colleagues if their own work led elsewhere.
Ah, so it prevented that sort of groupthink, hiding in the herd.
Exactly. No safety in numbers. You had to own your picks.
And they had a way to enforce that clarity too, didn't they? Something about a timer.
Oh, yeah. The famous 3-minute timer in the weekly meetings.
Yeah.
You had exactly 3 minutes to pitch your stock.
Wow. That forces you to get straight to the point.
Totally. No jargon, no rambling. The absolute benchmark was, could a fifth grader understand why you're buying this stock?
A fifth grader. Seriously.
That was the standard. If you couldn't boil it down that simply, the thinking was you haven't really grasped the core investment thesis. You're just hiding behind complexity.
That focus on simple core fundamentals must have enabled some huge and probably scary contrarian bets.
Oh, definitely. The classic example, the one everyone talks about, is Chrysler.
Right, 1982. Stocks at what, $2?
Yeah.
And everyone expects them to go under.
$2 a share, yeah. Bankruptcy seemed almost certain. I mean, betting big on that. It must have looked completely nuts to the rest of Wall Street.
So what did he see that others didn't?
He looked past the scary headlines, the financial chaos, and focused on the actual product, the new minivan.
The minivan, okay.
He called it, and this is a great quote, the first new thing in the auto industry in 20 years. He saw turnaround potential based on that product innovation.
And that bet, it obviously worked out.
Spectacularly, Chrysler eventually became the fund's single biggest holding, made up 5% of the entire fund.
5% on a stock that was almost bankrupt? That's conviction. It
Right.
really shows that idea of seeing opportunity in disaster.
Absolutely. When the market tanked, like those big 300-point drops in the 80s, he didn't panic. He saw
Bargains.
bargains, a chance to buy good companies cheaper.
Was there a rule or something he used to keep perspective during those panics? It's easy to say buy the dip, harder to do.
There was. Especially crucial back then, like 81, 82, when long-term government bonds were yielding maybe 13, 14%. Super high.
Okay.
He had this rule of thumb. Basically, owning stocks is almost always better than bonds unless the yield on long-term government bonds was more than 6% higher than the dividend yield of the S&P 500.
Ah, okay. So a clear quantitative check. It wasn't just gut feeling.
Exactly. It gave him a rational anchor, something concrete to stop emotion taking over when everyone else was running for the exits.
So pulling this all together, what's the key takeaway here for you listening to this? It seems like the success wasn't about market timing or complex algorithms.
Not at all. It boiled down to, well, ignoring the noise, ignoring the rumors, focusing relentlessly on the companies themselves, the fundamentals, and crucially, having the patience to let those big turnaround stories actually play out.
Patience is key. So let's leave you with a final thought, going back to that communication rule.
Right, the fifth grader test. If you're looking at an investment, any investment, and you try to explain why you're doing it.
Can you explain it simply?
Yeah.
Clearly. So simply that, yeah, maybe a bright kid could grasp the basic idea.
And if you can't, if it still feels fuzzy or relies heavily on jargon, are you really ready? Or are you perhaps just telling yourself a complicated story?
Something to definitely think about. Welcome to the Deep Dive. Today we're digging into the Magellan Fund, specifically during those later high-growth years.
Right. We're looking at the operating philosophy, really. How did the manager handle just enormous assets and, well, a frankly staggering number of stocks?
Staggering is the word. I mean, the workload hook here is intense. By mid-83, the sources say the portfolio doubled to 900 stocks.
Yeah, up from 450. And that meant a constant 60 to 80-hour work week.
Just to keep up.
Pretty much. The manager needed to know, or at least recall, the story for 900 different companies in like 90 seconds.
That scale, it's almost hard to grasp. And it definitely drew criticism, didn't it?
Oh, absolutely. People looked at 900 stocks and said, okay, this is just a closet index fund.
The argument being it's too diversified. No way to actually beat the market average with that many holdings.
Exactly. But that kind of misses the point of why so many stocks were held.
Okay, so explain that. What was the real structure?
Well, the sources are clear. 700 of those 900 stocks, they made up less than 10% of the total assets. Tiny positions.
Less than 10% for 700 stocks, so they weren't really investment bets then.
Not in the capital allocation sense, no. Think of them more like listening posts. Sometimes a small position was just to get information, maybe meet management.
Like that example in the source, Jan Bell Marketing, the jewelry supplier.
Precisely. A token holding. It was about information flow, building a massive real-time database from the ground up.
Okay, so if 700 were for Intel, where did the actual conviction bets lie?
Well, that brings us to the famous auto trade. Ran from about 1982 to 88.
Right, the big bottom-up play. Betting against GM, wasn't it?
Yeah, betting against GM and going long Ford, Chrysler, and even Volvo.
And that paid off.
Hugely. The sources note over $100 million in combined profits just from Ford, Chrysler, and Volvo over those 6 years.
Wow. Okay, so that directly counters the closet index idea. These were active, significant bets.
Absolutely. And notice, these weren't flashy tech stocks of the era. This was deep value in cyclical industries, overlooked stuff.
But still, betting against General Motors back then, the giant of Detroit, that feels like a huge contrarian risk. How was that justified?
Just relentless bottom-up research, digging deeper than others, and this appetite for overlooked value. It wasn't just in the U.S.
Ah, the global expansion. Started around 84.
Yep. Magellan started putting 10, sometimes 20% of assets overseas. They realized you had to look globally to find these kinds of opportunities consistently.
And we see that reflected in the research trips, right? To Sweden and Norway.
Exactly. Visiting companies like Volvo, Scandia, Norsk Hydro, it shows the effort required for true global bottom-up research back then wasn't easy.
And presumably that diversification helped when things got rocky, like in 87.
Definitely proved crucial. The manager saw the market getting, quote, wildly overvalued before the crash.
Okay, so the October 87 correction hits. That must have been the ultimate test for managing scale. Redemptions must have been huge.
They were enormous. The fund faced $1.1 billion in shareholder redemptions. Billion, with a B.
So how do you even handle that kind of outflow in a panic?
Tactically, they had to sell stocks to raise cash. The sources say they raised about $687 million quite quickly.
Was there a risk of selling too low, missing the immediate bounce?
There's always that risk, but the priority was meeting those redemptions. Discipline first. Liquidity was paramount.
Okay, so they managed the crisis. What happened after the dust settled? Where did the focus shift?
Back to cyclicals mainly, companies poised to rebound. And this is where you see a sort of surprising big bet emerge.
Which was?
General Electric, GE, described as a semi-stodgy blue chip, not your typical growth darling.
GE became the biggest position.
Yep. Accounted for 4% of the entire fund's value at one point. It shows a willingness to make huge conviction bets based on value, even outside the usual growth categories.
4% is a significant bet in a fund that size. But it wasn't all winners, right? The sources mentioned a key failure, too.
Oh, yeah. Texas Air. A painful lesson.
What happened there?
Held it too long, ignored Peter's principle, #13, never bet on a comeback when they're playing taps.
Meaning the situation was already hopeless.
Pretty much. The fundamentals just kept getting worse, and they lost $15 a share on that one. A reminder that discipline cuts both ways, knowing when to sell.
So pulling it all together, what's the big takeaway for you, the listener?
Well, I think the sources show that success at this massive scale isn't just about picking the Fords. It's about that relentless discipline, managing the data, making big bets like GE, but also having the humility to cut your losses, like they should have with Texas Air sooner.
Right. It's the whole system, not just the stock picks. Which leads to a final thought. We see here that even this manager, super focused on fundamentals, still lost money on big tech names of the late 80s, Digital, IBM, Eastman Kodak.
Yeah, names that seemed unassailable at the time.
So if even the best struggled to see the decline of the existing tech giants back then, what does that tell you about how hard it is to predict which new industry, which new companies will actually dominate the next cycle? Something to think about.
All right, today we're doing a deep dive into some really interesting source material. We're tackling, that fundamental question in finance. Is picking stocks successfully? Is it an art, a science, or maybe something else entirely?
Yeah, and our mission here is really to pull out the key pieces of a winning method for the long haul.
Okay, so let's get started.
Well, the sources, they jump right in saying, look, you can't just boil this down to a simple formula.
No magic recipe then?
No, definitely not. They actually warn about what they call a misguided faith in measurement.
Okay, like what?
Think ancient Greece, Sales the philosopher, right? So busy looking at stars, he falls into a hole.
Okay, I see. So don't get lost in complex data.
Exactly. It's not don't measure, it's don't over-rely on, fancy calculations and miss the obvious pitfall right in front of you. Common sense still matters. A lot.
Okay, so if it's not just science, what is it? The source talks about a blend, right?
Right. It's definitely part art, that gut feeling, the knack for seeing an opportunity.
And part science, actually reading the balance sheets, doing the numbers.
Correct. But then there's this third piece they really hammer home, legwork. Intense legwork.
And what does that mean exactly? Because it sounds like more science.
Well, it's practical science, maybe. What's interesting is how they define it. It's not about having the fanciest Bloomberg terminal, or reading every single analyst report out there.
Okay.
It's about digging deep into a, uh, a manageable number of companies, really knowing them, maybe better than the analysts covering 50 stocks.
So focus. Deep focus.
That's it. And they make a really compelling point.
Yeah.
The average person, you only need maybe one or two massive winners.
The 10 baggers they mention. Stocks that go up tenfold.
Exactly. Find a couple of those over your investing life, and it makes all that focused effort totally worthwhile. You don't need to own everything.
That actually sounds liberating. Takes the pressure off feeling like you have to follow everything.
It really does.
Okay, so legwork gets you the facts. Where does the art part come in? Maybe spotting when the market itself is getting ahead of itself, like the source describes in early 1992.
Spot on. That's a perfect example. The author says, the Dow shot up 300 points in just 3 weeks. Everyone's euphoric, but he felt depressed.
Which sounds completely backwards. Why feel bad when stocks are booming?
Because his legwork, his research, was telling him something different.
Yeah.
It informed his intuition, his art.
What did it show?
He saw that the big popular growth stocks back then, think Philip Morris, Walmart, Abbott, names like that, had, and this is the quote, strayed far above their earnings lines.
Meaning the price was way too high compared to the actual profits the company was making.
Precisely. The stock price was maybe growing, say, 3 or 4 times faster than the earnings were.
That sounds unsustainable.
It usually is. It's like the speedometer showing 100 mile per hour.
Yeah.
But the engine, the actual earnings, can only really do 30. That gap, that's your danger zone.
So the expectation should be...
What?
Crash?
Either the price has to come down or the stock just goes nowhere, stays flat for potentially years until the earnings finally catch up to that high price.
Okay, the numbers make sense, but then there's the psychology, right? Keeping your cool when things get weird.
Oh, absolutely. The source talks about our tendency to buy high, sell low, and then conveniently forget our mistakes.
Or worse, we sell something to cut a small loss, and then agony.
Yeah, you suffer that emotional shock, as they put it, of watching that same stock, maybe like Walmart back then, just double or triple after you sold it. That hurts.
So how do you fight that emotion? Just willpower.
Willpower helps, but strategy is better. The source actually gives a concrete tactic. Look at buying smaller stocks during the tax selling period.
You mean around November and December?
Exactly. That's when some investors sell stocks, maybe perfectly good ones, just to realize a loss for tax purposes.
Which pushes prices down artificially.
Right. It can create these little windows where prices are depressed for reasons that have nothing to do with the company's actual value. Great time for disciplined buyers.
So bringing it all together for you listening, what's the big takeaway?
I think the sources are really clear. Real success isn't about chasing hot tips or market timing in the short term.
It's about that disciplined effort, the legwork, controlling your emotions, and having the courage to maybe step back when everyone else is piling in, especially if the numbers look stretched.
Yeah, and think about this final point. If you truly believed you only needed, say, 5 great 10-baggers over your entire investing lifetime to really succeed.
5 stocks that go up 10 times.
Right. How much more intensely would you focus your energy, your legwork, on really understanding those potential 5, instead of just listening to the noise about 50 others?
You wouldn't chase headlines, you dig.
You dig deep. That intense, selective focus,
Mm-hmm.
that seems to be the core message, and that is a deep dive worth taking. Okay, so today we're trying something, well, a little different. We're testing this idea. Can your gut feeling about shopping actually beat Wall Street analysts?
Mm-hmm.
Our mission here is a deep dive into retail stocks. Can you really just watch people shop and find the next big winner?
Right. And this whole idea, it really comes from one core thought in our sources. If you like the store, chances are you'll love the stock.
Ah, the old Peter Lynch idea, sort of stick to what you know.
Exactly. It links right to that principle. Investing in what you personally see, what you understand. Our sources even mention, a place like the Burlington Mall.
Right, outside Boston.
Yeah, it's this perfect little lab, a place to just observe shoppers, see what's clicking.
And when you hear some of the numbers, it really makes you think.
Yeah.
Our research dug up this almost unbelievable story about Radio Shack back in the 70s.
Oh, yeah. Tandy owned them then.
Right, Tandy. A $10,000 investment then. It eventually turned into, get this, $1 million.
$1 million. From, selling cables and batteries. It's incredible. And look, that wasn't some one-off fluke either.
No, definitely not.
The research highlights a whole bunch of them between 86 and 91. Home Depot, The Limited, The Gap, big gains.
And the giant, of course, Walmart. I mean, The scale of that success is just staggering.
Really is.
The sources point out, what was it, a 50-fold gain between 1980 and 91 made Sam Walton a billionaire, basically, by figuring out how to sell everyday stuff better than anyone else.
Yeah, toothpaste and socks, like you said, it really proves that simple observation, just watching, can be a powerful starting point.
Okay, absolutely. But that success, it brings up a really tricky question for you listening right now. How do you spot the next Walmart without, paying way too much for it?
That's the million-dollar question, isn't it?
Let's use the Body Shop as maybe a cautionary tale here.
Yeah.
Seemed perfect on the surface, right?
Oh, totally. I mean, great story. Socially conscious, natural ingredients, recycling.
Expanding everywhere. Germany, Japan, loads of stores in the U.S. It looked like a can't-miss business.
And it was a great business. But here's where just liking the store isn't enough. You got to look at the financials. Valuation.
Okay.
So, 1992, the Body Shop hits this major red flag. Its price-to-earnings ratio, the PE, hit 42.
42. Okay, break that down. What does a PE of 42 actually mean compared to, say, the rest of the market back then?
It means it was really expensive. I mean, super expensive. The average for the S&P 500 index then was only like 23.
Wow, almost double.
Yeah. And even a global giant like Coca-Cola, a huge brand, was only trading at a PE of 30.
So 42 is way out there.
Way out there. It basically means you're paying a massive premium.
Huh.
And that high price tag, it demanded something almost impossible.
Which was?
The company basically had to keep growing at an incredible rate, something like 30% every single year for years and years, just for the stock price to make sense based on what you paid.
That sounds like a high bar.
It's an incredibly high bar, almost unheard of to sustain that.
Yeah.
So it proves a really vital point. A fantastic company can still be a terrible investment if you just pay too much.
So the lesson for the Body Shop is don't overpay, even for a company you love. But the sources also talk about the flip side, right? The pain of ignoring what you see.
Oh, definitely. Missing out because you didn't trust your own eyes.
The Gap comes up as a big one. Someone in our source material apparently watched their own kids wearing Gap clothes all the time, but just kind of overlooked it as an investment idea and missed, what, 1,000% return between 86 and 91? Ouch.
Yeah, 1,000%. That stings. And we see the same thing again with clearly Canadian, that sparkling water.
Oh, I remember that stuff.
Right, popular drink. The Observer noted how much their family liked it, saw it everywhere, but then just didn't act, didn't investigate.
And the stock took off without them.
Exactly. Watched it skyrocket later. Another missed opportunity based on direct observation.
Okay, so putting this all together for you listening, what's the real takeaway here? It feels like there are two sides to this coin.
I think that's right.
Observing consumers, your mall research, it's a powerful way to find potentially great businesses. But it's not enough on its own, is it?
Not at all. It's completely useless, maybe even dangerous, without that next step. The hard financial analysis, the sober judgment.
Right. Discovery is step one. Valuation is step two. You absolutely have to pair what you see in the real world with looking hard at the numbers.
Especially that PE ratio we talked about, and really questioning those future growth expectations. Are they realistic?
Okay, so for our final thought here, something provocative for you to chew on. Think about retail endurance. Think about Walmart again. Even after all that massive growth into the early 90s, our sources remind us they still only had about 15% of all U.S. stores. 15%.
Still lots of room to grow, theoretically.
Exactly. So beyond just opening more stores, what is it? What specific qualities allow a company like that to keep expanding, keep winning for decades without completely destroying its stock price for investors in the long run? That's the real test, isn't it? Welcome to the Deep Dive. Today, we're putting on our hard hats, maybe grabbing a metaphorical pickaxe. We're going prospecting.
And not for gold, right?
No, not exactly. We're looking for value. Value hidden deep inside financial fear. Our mission today is to analyze how some, very diligent investors use detailed financial digging to find amazing buys right in the middle of the 1991 real estate panic.
Oh, yeah. That was a scary time. A really scary time if you owned any property. For what, 2 solid years, real estate was the big financial worry.
Right.
The collapse of commercial real estate was everywhere, front page news. And the general feeling, the sentiment, was that this disaster was spilling over, hitting the entire residential market too.
And this is where our strategy kicks in. While all the headlines screamed collapse, screamed dread, there was this counter-narrative. A quiet fact, really. The price of the meeting house, it actually went up in 1990 and then again in 1991.
It's amazing, isn't it? That disconnect between the psychological panic and the economic reality on the ground. The residential market wasn't collapsing. Not really.
Affordability.
Actually improving.
Yeah.
Because interest rates were falling, the affordability index for buying a house was, maybe surprisingly, looking pretty good.
Okay, so the playbook becomes clear. You look for companies whose stock prices got absolutely hammered because they were associated with real estate.
Even if their specific niche, like residential, wasn't actually imploding, sector contagion, they call it.
Right, so the technique is basically wait for maximum pessimism, that peak fear, then roll up your sleeves, dig into the actual numbers, and buy the strongest players in that beaten-down group.
And a prime example was Toll Brothers, the home builder. The market saw them as, well, toxic, just because of the sector they were in. Their stock plunged from $25 all the way down to $5.
Wow. Like you said, a five-bagger in reverse, lost 80% of its value.
Just pure panic driving that.
But the sources, they suggest that drop wasn't really about Toll Brothers itself. The company's actual books told a different story.
Completely different. Their debt, it had fallen, their cash on hand, up to about $22 million. And critically, they had a 2-year backlog of secured orders for new homes.
Secured orders. So already paid for it, essentially.
Exactly. They were sitting on actual business. This wasn't some bet on a future recovery. It was investing in a company that was fundamentally sound, but just punished by terrible market sentiment.
And that realization must have hit the market eventually.
Oh, it did, and fast. The stock had a rapid rebound, jumped from around $8 back up to $12 pretty quickly once people looked past the fear.
Okay, let's shift gears slightly. Pier 1 imports. Now that's retail, home furnishings, not construction. Why did the panic drag them down so hard?
Well, think about it. Home furnishing sales, they're tied pretty closely to people buying houses, right? New construction, home turnover.
Okay. So the fear was nobody's buying houses, so nobody needs a new lamp or a sofa.
Exactly. That was the fear. But Pier 1, they weren't just hunkering down. They were actually executing this aggressive expansion strategy, opening like 25 to 70 new stores a year during that downturn.
Well, expanding and shoring up their finances, I read they cut costs, improved margins.
And they slashed their debt significantly by about $80 million over those 2 years. They were lean, expanding, and perfectly set up to grab market share as their weaker competitors inevitably stumbled.
Using the downturn almost like an opportunity.
Precisely. Which brings us to General Host. This one requires maybe the deepest dive analytically. It was a conglomerate, owned Frank's Nursery, and the stock was trading below its stated book value. Something like $7 a share versus $9 book value.
Okay, that's a flag. But, trading below book doesn't automatically mean it's a steal. How did analysts get comfortable that the $9 book value was, well, real? Especially when the market clearly didn't believe it.
Good question. 2 key things stood out. First, you saw significant insider buying. Management, executives, they were snapping up shares. That's often a good sign.
Suggests they believe in the hidden value.
Right. And second, the company had just made a smart move. They sold off their Callaway's nursery chain for about $40 million and used that cash to pay down a chunk of debt, made the balance sheet look healthier.
But there's always the question of asset quality within that book value. I remember seeing something about goodwill on their balance sheet, around $23 million.
Ah, yes. The goodwill, that's the tricky part. It's an intangible asset, right? Represents things like brand name, customer loyalty, the premium paid in an acquisition.
And often the first thing analysts mentally write down in a panic.
Exactly. But here's the thing. When you accounted for the debt reduction from that $40 million sale, and you really scrutinized the remaining assets, the source material calculated the sort of true underlying value of General Host was closer to $14 per share.
Wow, $14 estimated value versus a market price under $8 back in early '92. That's a huge gap.
A massive gap. And finding that gap, that's the power of synthesizing all that detailed data. The balance sheet, the asset sales, the debt structure to see past the general market gloom.
So in all 3 cases, Toll Brothers, Pier 1, General Host, you had companies with proven operational health, maybe even improving health.
Yet they were priced like they were on the verge of bankruptcy, purely due to sector fear.
It really highlights the core idea, differentiating between a company that's genuinely struggling and one that's fundamentally okay, just unfairly punished by the crowd. That's the essence of prospecting in bad news.
It is. It requires digging beneath the surface noise.
So wrapping this up, what's the key takeaway for you listening? When you see a stock trading way below its stated book value, don't just see a discount. See it as a big flashing signal.
A signal to dig deeper.
Exactly. You have to immediately ask, what specific questions does this raise about the quality and reliability of the assets listed on that balance sheet? Things like inventory, receivables, and especially those intangible assets like the goodwill we just talked about. That level of scrutiny, that forensic work, that's what can turn widespread bad news into a genuine opportunity.
Welcome to the Deep Dive. Today, we're jumping back to late 1991. We're looking at supercuts just after they went public.
That's right. The mission here is to figure out how this franchise model tried to disrupt what was a huge, mostly independent hair care industry. We're talking, what, maybe $15 to $40 billion back then?
Huge and fragmented.
Exactly. And our sources give us this great little snapshot. You've got your classic neighborhood barber, let's call him Vinny DiVincenzo, charging maybe $10.
Right. The standard cut.
Then boom, December 91, you walk into a Supercuts on Boylston Street in Boston, and it's $8.95.
Cheaper. Not by a lot, but cheaper.
But that difference, even just $1 or so, hints at the real question. How did they manage that? What was the efficiency, the secret sauce?
Yeah, and investors were definitely paying attention. The IPO was in October 91, priced at $11 a share. Pretty solid valuation.
And that valuation was riding on this idea, this theory, that the independent barber, Vinny, was sort of a dying breed.
A vanishing act, creating a gap in the market.
Precisely. A gap that a really well-managed, efficient national chain could fill. And Supercuts basically started by buying out another chain, McTrim, and then scaling up that concept.
Okay, so how did they actually achieve that efficiency? It wasn't just about being bigger, right?
No, not just size. It was about rigorous standardization.
Oh.
The core strategy was training stylists to be incredibly efficient. Fast, basically.
Right. Okay.
They had a specific target, 2.8 heads per hour.
2.8. That sounds incredibly specific.
It is, and that's the operational linchpin. It dictates scheduling, staffing, everything. The goal was uniformity. The haircut in Miami had to be identical to the one in, say, Albuquerque. Same speed, same result.
So it's like a production line, but for haircuts, that 2.8 number is kind of the whole game then.
It really is. Maximize cuts per chair, per hour, minimize waiting, get people in and out.
Okay, let's talk about the stylists then. These are licensed professionals.
Absolutely. Licensed cosmetologists.
Yeah.
Earning back then maybe $5 to $7 an hour. Plus they got medical benefits, which was significant.
Okay. Decent wage plus benefits. But how does that stack up against the revenue they bring in?
That's where the leverage is. At that 2.8 heads per hour rate, doing $8.95, a single stylist is pulling in something like $30 an hour for the franchise.
Wow. So $5 to $7 an hour cost versus $30 an hour revenue, that's a pretty healthy margin.
Much healthier than Vinny, the independent guy charging $10, could likely achieve on his own.
And interestingly, the sources point out a demographic shift too, not your old school barbershop crowd.
Not at all. It says something like 95% of the customers were female and over 80% of the employees too.
That's fascinating. So the efficient standardized model appealed more to and was operated more by women.
Seems so. Now, to grow this thing nationally, they needed fuel. And that came from the franchise model itself.
Right, the franchisees put up the capital.
A lot of it. A big upfront fee, maybe around $100,000 just to get the store set up. Then ongoing royalties.
What kind of royalties?
Supercuts Corporate got 5% of the gross revenues from haircuts and 4% from any product sales like shampoo and stuff.
Okay, so a steady stream of income for corporate, funded by the franchisees. But how did they maintain that crucial 2.8 heads per hour standard across hundreds of stores?
Training. Massive, massive investment in training. This was actually their biggest expense, apart from, rent.
Bigger than paying the stylists.
Well, maybe not per hour, but in terms of dedicated infrastructure cost, yes. They hired a new trainer, paying them like $40,000 a year for each new store.
For each store. One trainer per store initially.
That's what the source suggests. Plus, another $300,000 a year sunk into training infrastructure for every group of 10 new shops they opened.
That's a huge commitment, all just to make sure everyone could hit that 2.8 number consistently.
Exactly. Standardization doesn't come cheap, but it allowed them to scale.
And connecting this back to the finances.
Right. The beauty of it, strategically, was using that franchise money, the upfront fees, the royalties, to pay for this huge training operation and the rapid expansion.
So they didn't need to drain their own capital reserves or take on tons of debt to grow and fight off competitors like Regis.
Pretty much. The growth engine was kind of self-funding. It's quite clever, really.
So recapping, Supercuts took a personal service, standardized it down to a number 2.8 heads per hour, enforced that with huge investments in training, and funded the whole expansion using the franchisee's own money.
That sums it up nicely. They built a scalable machine for haircuts.
But here's a final thought from the sources that really makes you pause.
Yeah, this one's interesting.
We've talked about how the stylists are licensed professionals. They have to pass exams to be allowed to cut your hair.
Right. State requirements, specific training.
Yet the sources point out that back in '91, to manage, billions of dollars as a fund manager, well, there were basically no comparable requirements.
Yeah, the comparison was stark. Essentially, you needed more formal qualifications to trim someone's sideburns than to manage vast sums of money.
Makes you think, doesn't it, about how we value and regulate different kinds of expertise, handling hair versus handling fortunes.
Definitely food for thought.
Welcome to the deep dive. Today, our mission is, well, it's about cutting through all that market hype. We're digging into a pretty counterintuitive idea for finding great investments.
Yeah, we're calling it blossoms in the desert. Basically, looking for really successful companies, but in industries that most people think are, frankly, lousy, unpopular.
Okay, unpopular industries. That feels wrong somehow. Don't you want to be where the growth is? AI, fancy tech, medical breakthroughs.
You'd think so, right?
Yeah.
But that's where it gets interesting. When an industry is too popular, like Yogi Berra said, sometimes nobody goes there anymore.
Oh, okay. Meaning?
Meaning everyone piles in, you get way too much competition, everyone fighting over the same customers, and profits just get squeezed. It's often the opposite of what you expect.
So chasing the hot new thing isn't always the winning ticket. But, surely a company in a fast-growing sector has a better shot, even with rivals. The whole pie is getting bigger, faster.
That's the assumption we're challenging today. The sources argue that super popular industries often lead to weak returns precisely because they're popular. The real gems. Sometimes they're companies quietly taking over a bigger and bigger slice of a market that's not growing much at all, maybe even shrinking.
Okay, I'm intrigued. So these desert survivor companies, what makes them tick? What do they actually do differently? It can't just be luck that they thrive when the industry is tough.
No, definitely not luck. There's a shared DNA, you could say. First off, they are absolutely obsessed with being the low-cost operator. Penny pinchers through and through.
Right, keep costs down. Makes sense.
But here's where it gets really interesting, the culture. They totally throw out that typical corporate hierarchy. The execs in corner offices, the frontline workers feeling like cogs in a machine.
So less bureaucracy, maybe more like internal fairness.
Exactly. Their people tend to be paid well, often better than the industry average. And critically, they usually have a stake in the company, profit sharing, stock options, something like that.
Yeah.
They feel like owners.
Okay, so motivated workforce. What about the top brass?
That's the other side of the coin. Intense frugality.
Yeah.
We're talking modest offices, maybe even bare bones headquarters. Low debt is key. And they keep executive pay reasonable. No gold-plated faucets or fleets of private jets.
So this penny pinching isn't just for show, it's fundamental. It lets them maintain that cost advantage.
It's baked into how they operate. It's core.
Okay, let's make this real. Give us an example. How did this play out in a notoriously bad industry? Like, say, airlines, Southwest, right, LUV.
Southwest is the absolute classic case study. Think about the 1980s, a graveyard for airlines. Pan Am, Braniff, Eastern. All going bankrupt or struggling badly.
Yeah, total chaos.
But Southwest, their stock went up tenfold between 1980 and 1990. Tenfold. And why? Simple. They were the lowest cost operator, period.
How low are we talking?
Their operating cost per available seat mile, that's the key metric, was about 5 to 7 cents. The rest of the industry, more like 7 to 9 cents or even higher.
Wow, just 2 cents, maybe 3. But multiplied by millions of flights and seats, that's huge.
That's the difference between thriving and dying. And they lived that frugality, didn't they? I remember reading about them using converted army barracks for offices early on.
Yeah, and apparently just an old black rotary phone at the front desk for ages, no frills.
Exactly. No frills, just efficiency. They focused on short-haul, low-fare routes, their niche, and just executed flawlessly. That relentless execution is the common thread.
Okay, airlines are tough. What about retail? Another bloodbath.
Oh, yeah. Think about Sun Television and Appliances. Ticker was SNTV. Appliance retail is brutal thin margins, constant price pressure.
Right, tough business.
And yet Sun TV, based in Ohio, was this high-volume discount powerhouse. Even during the 1990 and 91 recession, when lots of retailers were struggling, Sun TV was profitable and expanding.
Expanding. In
Inve-
recession.
Vigorously.
Yeah.
They opened 7 new stores in 91, planned 5 more for 92. They just outworked and outmanaged everyone in their market by sticking to that high-volume, low-cost model.
So it's not the industry, it's the execution within the industry.
Precisely. And look, this isn't just anecdotes. The data backs it up. There was this portfolio tract back then called the Magnificent Seven plus one. It was built around companies following this exact model.
And how did it do?
Get this, the companies were things like Cooper Tire, Shaw Industries, even Green Tree Financial, which did mobile home loans. Talk about unglamorous.
Mobile home loans. Okay, so the results.
From 1990 through 1991, that portfolio delivered an 87% average total return. 87.
87%, while the overall market.
The S&P 500 managed only 26% in that same period. It's just a massive difference. It really shows that nailing operations in a forgotten corner of the market can trounce chasing the latest craze.
Wow. So the big takeaway here, the synthesis is, what? Competition isn't always good for business.
Basically, yeah. For an individual company, competition might be healthy for the customer, but total domination is way better for the bottom line. These companies found these overlooked niches, built these frugal, fair cultures, focused relentlessly on cost, and just dominated. They made their own growth by being the best, not by riding some industry wave.
It makes you think.
Okay.
So here's the final thought for you listening. If companies making retread tires, like Bandag was known for, or financing mobile homes could crush the market just by executing perfectly on the basics, what boring, lousy industry out there today is just waiting for its low-cost, obsessive champion?
Yeah, what fundamental service or product is everyone ignoring? Where's the next blossom in the desert?
Something to chew on until our next deep dive. Welcome to the deep dive. Today we're tackling a really big one, the savings and loan crisis. Late 80s, early 90s.
Yeah, it was huge. We're talking $500 billion. That's $500 billion taxpayer bailout.
And something like 675 S&Ls went bankrupt, right? Was collapsed.
Exactly. It really shook things up. You had figures like Charles Keating, making headlines, makes the guy from It's a Wonderful Life look tame.
Huh, yeah. So our mission today is to kind of unpack how this happened and maybe more importantly, figure out what the ones that survived did differently.
Right. And the source material we're using, it breaks them down nicely into 3 groups.
Mm-hmm.
The bad guys, the greedy guys, and the survivors called the Jimmy Stewarts.
Okay, let's start with the bad guys. Sounds like straightforward criminals.
Pretty much. Pure fraud artists. Like there was one called In God We Trust SNL.
Seriously? Okay, what did they do?
Well, they pulled in about $19 million in deposits really fast.
How? By offering these crazy high interest rates like 13% on jumbo CDs.
13%? How is that even possible unless, the deposits were insured? That's the hook. The FSLIC, the Federal Savings and Loan Insurance Corporation, guaranteed it all. So depositors felt safe.
But the SNL owners, they weren't planning on making good loans.
Not really, no. They barely put any of their own money in, maybe $1 million in equity. But they immediately started skimming massive fees, getting kickbacks.
So leveraged corruption, basically.
Totally. And spending lavishly. I mean, the source mentions importing elephants for parties to impress politicians. Just wild stuff.
Wow. Okay, so that's outright fraud. What about the greedy guys? Different kind of failure.
Yeah, different flavor. Think first backwater savings. Not initially criminal, just incredibly greedy. They thought boring home loans weren't cutting it.
Wanted higher returns.
Exactly. So they jumped into bed with developers, funding really high-risk commercial stuff, office parks no one needed yet, speculative condos, malls.
Yes, that was great in a boom, but...
But craters in a recession.
Yeah.
And that's what happened. When the economy turned, those loans defaulted massively, their whole net worth, gone in under 5 years.
Just evaporated. Okay, so after hearing about elephants and reckless speculation, the Jimmy Stewart approach sounds, well, refreshingly boring.
Absolutely. Boring was the key to survival. These S&Ls, like Golden West, were just very careful, low-cost operators.
Sticking to the basics?
Yep. Old-fashioned secure home mortgages. They actively avoided, all that unnecessary excitement, junk bonds, risky commercial deals, just steady operations.
And they managed this through tight controls, right?
Yes.
Something about the spread.
Precisely. The spread was critical.
Yeah.
There's a difference between the rate they earn on loans and the rate they pay depositors.
Okay.
They needed at least a 2.5% spread just to cover their overhead, their expenses. Their theoretical break-even was maybe 1.5%. Very lean.
That discipline seems key. So if you were trying to quickly gauge an S&L's health back then, what was the #1 metric?
Oh, definitely the equity to assets ratio, EA. It's the fundamental measure of strength, kind of like the S&L shock absorber.
Right, the cushion against losses. What was considered good?
You really wanted to see 7.5% or higher for safety. Average was maybe 5.5% to 6%. Anything below 5%, and you're in the danger zone.
Got it. So like a big bank, JP Morgan, might be around 5%, but the really solid S&Ls.
The really strong ones, like a People's Savings Financial mentioned in the source,
Yeah.
were way up there, maybe 12.5%. Huge difference in resilience.
That makes sense. Were there other quick checks people could do?
Yeah, two other vital signs. First, 90-day non-performing assets. Basically, loans already going bad that need to be less than 2% of total assets.
So keep the bad debt low.
Right, any higher. And it's eating away at that equity cushion. Second, high-risk real estate assets. That's the commercial stuff. Keep it under 10% of total assets.
Ah, so avoiding that first backwater model, don't load up on risky commercial projects.
Exactly. Stay below 10%.
So the big takeaway for you listening seems to be, well, stability came from being deliberately unexciting, avoiding risk, keeping operations simple, and having that strong equity to assets ratio.
That's the core lesson. Be boring, be safe, mind your ratios.
So any final thought on this?
Well, here's something interesting. Even amidst all that chaos and failure, some of those really well-run Jimmy Stewart S&Ls, the source names ones like Germantown or Glacier, they kept the ratios strong.
Yeah.
But because the whole sector was, tainted, their stocks were often trading way below their actual book value. So if you understood these ratios, you could spot these born-again bargains. Real financial strength hiding in plain sight.
Fascinating. Finding value when everyone else is running scared just by looking at the fundamentals.
Precisely. The numbers told the story.
Okay, let's unpack this. Today, we're diving into a stack of sources all about savings and loans S&Ls. Now, this sector, it often sounds pretty dense, maybe a bit technical, but the research mission here was actually quite simple. Find a specific, really powerful investment opportunity that Wall Street analysts were just overlooking, all through meticulous due diligence.
Right. And what's fascinating here is you really need to grasp the basic mechanics first. In S&L's fundamental model, it's inherently simple. They borrow money, usually deposits at a low rate, let's say 3%, and then they lend it out at a higher rate, maybe 6%. That margin, that spread, that's what runs the business.
Yeah.
But you get that basic 3s and 6s idea, well, then you can start spotting the interesting stuff.
Okay, but if the underlying model is that simple, why were S&Ls always seen as so notoriously complex, so hard to analyze? Our sources really highlight that diversity through some case studies, like look at Glacier Bancorp. They worked hard, really hard, to project this sophisticated, growth-oriented image, acquiring smaller places like Whitefish Financial. But the analysis suggested they were potentially paying, well, way over their book value.
Book value, just the tangible assets minus liabilities per share.
Exactly. So were they just overpaying for growth?
And that raises a really important question. How do you spot the rare bird, the truly conservative institution? You look at companies like, say, Germantown Savings in Philadelphia. Big assets, $1.4 billion. Solid book value, $26 a share. But they were so exceptionally prudent. Sometimes they'd sell profitable investments specifically to push down their regular earnings.
To make themselves look worse.
Intentionally. It sounds bizarre, but it's actually a fantastic signal of just how careful they were. Real prudence.
Okay, then you had the other end of the spectrum, the dynamic players. Sovereign Bancorp, for instance. They shifted strategy. Instead of holding mortgages, they sold them off quickly to packagers like Fannie Mae or Freddie Mac. Get the cash back faster, lend out more.
A different model. Faster turnover. But risk wasn't always off the table.
Right. People's Savings Financial showed that risk. They struggled with non-performing assets, stuff categorized under that specialized term REO.
Real estate owned basically foreclosures the bank now holds directly, a drag on the books.
Exactly. But navigating all that internal complexity, all the different strategies, that was actually kind of a distraction from the real prize.
This is where it gets really interesting. The massive potential, the overlooked gem. It wasn't in the shaky or even the complex S&Ls we've talked about. It was hiding in plain sight with mutual savings banks.
Mutuals.
Those are the ones cooperatively own their depositors.
Right.
Precisely. And here's the absolute key. When they decide to convert to a stock company, go public through an IPO, the initial stock price is often set, sometimes significantly, below the actual book value.
Hang on. That sounds, well, almost too good to be true. Let's break down that math slowly. This is the core of that cash in the drawer rebate idea.
Exactly. Think about it. The existing net worth, it already belongs to the depositors. So when they do the IPO, the money from selling new stock, it flows right back into the institution's equity.
Okay. So new buyers bring in cash
which immediately becomes part of the equity base.
that their own shares represent. Are you saying they're essentially buying the asset, but maybe getting a chunk of their purchase price back immediately in equity, like buying at a discount?
You've got it. Let's use an example. Say a bank starts with $10 million in book value. It sells $10 million in new stock in the IPO. Suddenly, the bank's equity doubles. It's now $20 million. But the stock you just bought might still be priced based on that initial $10 million valuation.
Yeah. Wow. So your share could instantly represent or be associated with twice the original value underpinning it.
It's a structural arbitrage.
Yeah.
And the returns for people who understood this, truly staggering.
And the numbers really back that up, don't they? Our sources looked at 1991, 16 thrift IPOs. The worst performer was still up 87%.
87% for the worst one.
And the rest doubled or even better. Magna Bancorp was mentioned, a 10-bagger, made 10 times the initial investment in just, 32 months.
Incredible returns. These middle-of-the-road neighborhood S&Ls, they were called the best investments that hundreds of thousands of people have ever made.
Yeah.
Simply because of this mechanical quirk in the conversion process.
So what does this all mean for us looking back? The lesson seems clear. Deep, targeted diligence, especially in these complex, maybe overlooked sectors. It can uncover situations, these structural loopholes like the mutual bank IPO, where the math itself almost guarantees a potential bargain just because of how the capital structure gets reset.
Absolutely.
Yeah.
And timing was crucial. At the time of the analysis, the sources noted there were still, I think, 1,372 mutual savings banks that hadn't gone public yet.
Still a lot of potential there, then.
A huge pool here.
The core insight is that the stock purchaser essentially gets this pre-funded equity position. It's fascinating. So we want to leave you, the listener, with this thought. When you look at your own bank, your own relationship with them, how much value does your safety deposit box or even just your checking account actually hold for that institution? And are you absolutely sure you're not missing out on some kind of hidden rebate right under your nose? It's something to think about. Okay, so let's dive in. We're looking today at a pretty specific corner of the market, right? Master limited partnerships, MLPs.
Yep, MLPs.
Right.
Often ignored, sometimes for good reasons, sometimes not.
Right. And our mission really is to figure out how these things generate those high yields we sometimes see. And maybe, just maybe, is all that complicated tax stuff actually helpful? Like, is it the secret sauce for finding a deal?
It's a great question. Because, MLPs do carry some baggage. Historically, they got tangled up in some tax shelter boondoggles, as the source puts it.
Right. Bad press.
Exactly. So Wall Street often just looks the other way. But here's the counterintuitive part, the really interesting bit.
Okay.
The complexity, specifically the tax forms, the K-1 form you get.
Yeah.
It's enough of a hassle, enough of a nuisance, that it keeps bigger institutions and, frankly, a lot of regular investors away.
So the paperwork itself creates a kind of barrier. It keeps the stock less popular, maybe cheaper than it should be.
Precisely. You get this potential nuisance discount, creating the bargains we're looking for.
Okay, I see.
And the reason they can offer those high yields, fundamentally, is structural. By law, MLPs, especially the ones in real estate or energy infrastructure, pipelines, that kind of thing, they have to distribute almost all their earnings. It comes back to you, the shareholder, either as dividends or sometimes as a return of capital.
Return of capital, that just lowers my cost basis. Right. Not taxed immediately like a dividend.
That's usually how it works, yeah.
Yeah.
So that mandatory payout makes them very attractive for income investors. They're kind of built for yield.
Okay, let's make this concrete. The source talks about EQK Green Acres. A mall MLP on Long Island? Sounds maybe unexciting.
Well, yeah, malls aren't exactly hot right now. But this one was interesting. It actually raised its dividend 13 quarters in a row.
13, wow. So what was the story there?
Well, the fascinating thing was the disconnect. Everyone's down on malls.
Right.
But this place, it had a super low vacancy rate, like 4% average. That's really good for a mall.
So a quality asset, basically.
Seems like it. But the stock price was depressed. Why? Because the company was highly leveraged. Lots of debt on the balance sheet.
Okay, so debt risk. Makes sense. Vulnerable to a downturn.
Exactly. And then you add recession fears, plus rumors started swirling. Maybe they'd lose big tenants like Sears or J.C. Penney.
Oh, boy. That sounds like a recipe for panic selling.
It often is. And this is where the source material gives some classic advice. Don't sell on panic. Don't buy just on rumors.
Wait for the dust to settle.
Yeah. The source uses that old phrase, don't buy at the sound of cannons. Wait for clarity. You might miss the absolute bottom, sure, but you protect yourself if the rumors turn out to be just noise.
Good reminder. Okay, let's shift gears. Sun Distributors, another MLP, spun out of Sun Oil, but doing something totally different, distributing auto parts.
Right. And Wall Street, again, kind of ignored this one post-spinoff.
Why? What was the business like?
Pretty straightforward, actually,
Yep.
and profitable. High margins.
Yeah.
Like making $40 profit for every $100 of parts sold. That's solid.
Okay, sounds good. So what's the insight here?
The key was management's focus. They used that strong cash flow relentlessly to pay down debt. Their debt had gotten really high, maybe 60% of capitalization.
Wow, that is high.
Yeah, but they chipped away at it using the cash the business generated. And this highlights a crucial point for MLPs.
Which is?
Focus on the cash flow, not just the reported earnings number.
Because the accounting can be misleading, especially with MLPs.
Exactly. MLPs often have huge non-cash charges, like depreciation on all those pipelines or buildings.
Yeah.
It lowers their taxable income on paper.
Which is good for taxes.
Right, but it doesn't affect the actual cash coming in the door.
Mm-hmm.
Accounting rules, things like goodwill write-offs, might make the reported profit look worse, but the cash flow could still be super healthy.
So you're saying, look at the cash available to pay down debt and distribute to shareholders. That's the real measure.
That's the core of it, yes.
Yeah.
Understand the cash generation.
Okay, so pulling it all together, MLPs aren't simple. You need to do your homework, look past the K1 hassle, past the old stigma.
Definitely need due diligence.
And the success stories we looked at, like Sun's Debt Focus or other examples like Cedar Fair's amusement parks, mentioned in the source, they all point towards focusing on intrinsic value, right? Understand the business, the assets.
And the cash flow, absolutely. And management commitment to quality.
So if we think about applying this, the source suggests something about a year-end review.
Yeah, it's a great discipline. The idea that successful investors constantly reevaluate. They don't just buy and hold passively forever. They ask tough questions.
Like what?
Like asking yourself about every single thing you own. Why do I still hold this? Really, why? And maybe more importantly, why shouldn't I sell it and put that money into something better next year?
That's a sharp filter. So a final thought for you, the listener, to chew on. Apply that critical filter to your own holdings. Ask those questions. Why this? Why not something else? Let that guide your next move. Welcome to the deep dive. Today, we're digging into, well, a really counterintuitive part of the market. Cyclicals. We mean industries like steel, airlines, autos, the ones that reliably rise and fall with the economy.
Right, like economic seasons.
Exactly. And our mission today is to figure out how the pros try to time the real bottom in these sectors. Because it's tricky.
Oh, timing is absolutely everything. And it's tricky because cyclicals, they kind of operate on this paradox.
Okay.
When the economy feels absolutely miserable, like really in the doldrums, that's precisely when professional money starts buying them up. They're anticipating the recovery that seems miles away.
Okay, wait, let's unpack that right there. Because for most stocks, a low price-to-earnings ratio, the PE, that's usually seen as a bargain, right? You pay less for the earning.
Usually, yeah. That's the standard thinking.
But you're saying with cyclicals, a low PE might actually be a warning sign.
Exactly.
Yeah.
Sounds backwards, but think about it. If a cyclical company is suddenly making tons of money, earnings boom, and the PE looks really low, really attractive, but the smart money, they often know that peak prosperity is just about over. That's their signal to get out.
Okay, so the good times are already priced in and maybe ending.
Pretty much. And conversely, if earnings are temporarily awful, I mean truly terrible, the PE ratio might shoot sky high or even be meaningless because there are no earnings.
Right.
That high PE, counterintuitively, can signal the worst is passing, that maybe a dramatic earnings improvement is coming. So, yeah, you often have to invest when things look bleakest.
Got it. Okay, let's make this concrete. A perfect example you brought up from the resource sector. Phelps Dodge, the copper producer.
Classic case.
The rule seems to be invest when the economy's struggling, but the company needs like a fortress balance sheet. Why is that financial strength so non-negotiable?
Well, it's simple survival, really. It ensures they can actually make it through the low tide. Phelps Dodge followed that pattern perfectly. Earnings dropped hard in '91. Stock fell. I think it went from around $59 down to $26.
Yeah, something like that. But the thing that jumped out, looking back at their 1990 annual report, was the specific numbers. They had, what, $1.68 billion in equity?
Right.
Versus only $318 million in total debt. I mean, bankruptcy just wasn't really on the table, was it? No matter how low copper prices dipped.
Not really, no. They had the financial muscle, the capital, to just wait it out, wait for that inevitable revival.
And when that revival hits, the leverage is kind of amazing.
It's explosive. Because of that inherent leverage, think about it, Phelps Dodge produced about 1.1 billion pounds of copper a year back then.
Okay.
If the price of copper moved up just 1 penny per pound,
Just a penny.
yeah, the math showed it instantly added something like $11 million in pre-tax earnings, or about 10 cents per share. That's the kind of high leverage you're looking for during a recovery phase.
Okay, moving from digging stuff out of the ground to building things?
Let's talk General Motors, another classic cyclical.
Absolutely. Autos. By the 91 recession, GM stock was, I think, down about 50% from its recent peaks. How do analysts even begin to assess the turn in a huge industry like autos? Is it just guessing?
Well, it's interesting. Auto analysts actually rely heavily on this pretty reliable non-financial indicator. It's called units of pent-up demand.
Pent-up demand. Okay, what does that mean exactly?
It's basically just calculating the backlog of delayed purchases. You know, people who desperately need a new car if their old one's fallen apart,
Right.
but they're putting off buying because the economy feels shaky. They wait until things feel more secure.
That makes total sense. So you can actually track that backlog. By 91, how significant was that pent-up demand?
The analysts had crunched the numbers. They figured pent-up demand was at about 2.656 million units.
Wow, over 2.5 million cars.
Yeah, a huge number. It strongly suggested a pretty significant boom was coming, as those delayed purchases inevitably had to happen.
And I remember the headlines around GM then. The public perception was just terrible. They were called arrogant, myopic.
Oh yeah, the press was brutal.
It must have taken real conviction to look past that negativity.
It really did. Because if you actually dug into the financials beyond this sort of public image stuff, things were stronger than they looked.
Yeah.
GM's other divisions, like its financing arm, GMV, and its aerospace businesses.
Right, the non-auto parts.
Exactly.
Yeah.
They were still performing pretty solidly. They were providing crucial cash flow, buffering the slump in the actual car business.
So that underlying strength, combined with the pent-up demand, that made the potential upside much clearer. GM stock was around $31 in early 92, I think.
Yeah, about that.
And the projections, if the economy recovered like expected, suggested the stock could easily hit, what, $48 to $64 a share?
That was the range people were looking at, yeah. It's significant potential gain.
Yeah.
But you had to buy it when everyone else was fearful.
So if we tie this all together,
Yeah,
successful cyclical investing seems to be this two-part equation.
I think so. First, you need to anticipate the turn. Use indicators like that pent-up demand figure, something tangible.
Okay, find the signs of spring.
Right. And second, maybe even more important, you have to ensure the company has the financial strength, the balance sheet fortitude like Phelps Dodge did, to actually survive until that spring arrives.
Survive the winter. It really is a game where patience gets leveraged, doesn't it? And it brings to mind that old investing saying,
Which one?
unless you're a short seller or a poet looking for a wealthy spouse, it never pays to be pessimistic.
That's a good one. It fits perfectly here.
It does.
And it maybe raises a final thought for you, the listener, to mull over. If you've done the homework, you've confirmed the balance sheet is solid. How much of your eventual success is just about having the patience to wait for that known economic cycle to turn, rather than trying to perfectly, obsessively time the absolute lowest point?
Something to think about. Thanks for walking us through that.
My pleasure. Okay, when you think about investing in the energy sector, usually, utilities come to mind first. They're seen as the bedrock, right? Safe, reliable, slow, steady dividends. Kind of like that sturdy but maybe a little boring brick house in your portfolio.
Yeah.
But what if I told you there's this hidden corner, specifically within utilities, the ones dealing with, well, massive failed projects, an investment niche that's got this wild mix of huge risk and potentially explosive returns? Today, we're doing a deep dive into what you might call nukes in distress. We're looking at the stories of utility companies basically crippled financially because of giant nuclear power projects that failed, got mothballed. The works. Situations where supposedly stable stocks just plummeted, sometimes 80%, almost overnight.
Yeah, and what's really interesting is when one of these multi-billion-dollar projects goes south, or you have a major incident like, say, 3 Mile Island, it's not just the company that's in trouble. It actually throws the whole regulatory system into a spin.
Yeah.
Well, utilities are regulated monopolies, right? They provide essential stuff, power, water. You can't just let them go bankrupt and, switch off the lights for a whole city.
Right.
So you've got this tension. The company is financially devastated, but it kind of has to survive. And that paradox, that's what creates this incredible stock volatility. But it also creates a kind of pattern, a blueprint for a potential massive rebound.
The blueprint. Like predictable stages.
Exactly. And that's our mission today, to map out the 4 distinct stages these distressed utilities usually go through. If you understand this process, well, you could have spotted chances to double, triple, even quadruple your money.
Mm.
Or in some cases, like CMS Energy, we're talking a 9-fold return. It's about seeing past the panic with some patient analysis.
Okay, let's jump right into what sounds like the worst part. Stage 1 disaster strikes, the financial collapse. You said it's abrupt, not a slow decline. What's the actual trigger?
It's that sudden realization, often hitting the market all at once, that the company's facing enormous costs. Maybe fuel prices spiked unexpectedly, but more often, it's the cost of mothballing a huge nuclear plant. Costs they just cannot immediately pass through to customers.
Mm-hmm.
The key mechanism that breaks down here is the rate base.
Okay, break that down for us. The rate base is pretty central to how utilities work, isn't it?
Absolutely crucial. Think of the rate base as basically the total value of the asset the utility owns, power plants, lines, substations that regulators allow to earn a set profit on from customer bills.
Got it.
So when a multi-billion-dollar asset like that nuke plant suddenly becomes worthless, it fails, it's shut down permanently, boom, it gets yanked out of the rate base calculation, the asset value vanishes. But the debt, the billions they borrowed to build it, that's still very much there.
So earnings just collapse because the profit engine shrinks, but the debt load doesn't.
Precisely. That massive gap opens up on the balance sheet almost instantly. And the market reaction, well, it's devastating.
Devastating how? What kind of numbers are we talking?
We're talking the stock price just getting hammered. A drastic loss, usually somewhere between, say, 40% and even 80% of its value. And pretty quickly, often within 1 or 2 years, the market suddenly panics, thinking, how can this company possibly survive without some kind of regulatory bailout?
And looking back, the examples are just staggering, especially because these were meant to be conservative investments, like Con Ed back in the 70s.
Right. Con Ed dropped from $6 a share down to about $1.50 in 1974. Huge nuclear asset mothballed.
And General Public Utilities, grappling with 3 Mile Island.
GPU, yeah, that was 79 to 81. Their stock plunged from around $9 to just $3.88.
Then you hit the early 80s, Long Island Lighting, LILCO. That went from $17.50 down to $3.75 in 83.84.
Yeah.
And energy, similar story, $16.25 down to $9.25 around the same time.
Imagine being an investor looking for stable income and holding those. Absolutely wiped out.
So at the bottom of this plunge, stage 1, what does the valuation look like? You mentioned a key metric earlier.
Yes, this is critical for stage 1. At its absolute low, the stock is often trading at just 20 to 30% of its book value.
20% of book.
Yeah. Think about it like this. Book value is roughly what the company's assets are worth on paper. So you're buying $1 worth of assets for 20 or 30 cents. It's like buying a house for $20,000 when it's listed at $100,000 because you know it has a massive roof leak, the failed nuke.
Right.
But you're betting the city needs the house standing, so somehow, someday, that leak has to get fixed.
Okay, wait. If it's trading at 20 cents on the dollar, that seems like a screaming buy. Why isn't everyone piling in? What's the real risk you're taking there?
The risk is pure, unadulterated regulatory failure. That's the fear gripping the market. The terror is that the debt load is just too big, and the state regulators will simply refuse to grant rate increases or any other mechanism to let the company recover. They might just say, nope, you eat the loss.
So you're not just betting on the company, you're betting on the regulators eventually blinking.
You're betting on the fundamental principle that the lights have to stay on, that the state, one way or another, must find a way. But it's definitely a bet.
That terrifying low point, that bet on survival, leads us into stage 2, crisis management. This is where the company itself tries to stop the bleeding, right? Austerity and, well, a lot of uncertainty.
Exactly. Management has to go into full-on survival mode. They try to halt the damage with, frankly, a brutal austerity budget, slashing operating costs, freezing any and all capital spending. They basically curl up into a defensive ball, just trying to conserve every penny of cash.
And there's one action, you said, that's particularly painful but absolutely defines this stage.
The dividend. It gets slashed, often completely eliminated.
Ouch.
Yeah. This is the absolute marker for stage 2. From the company's view, it's necessary to hoard cash. But for Wall Street, it's the ultimate signal. The company's survival is genuinely in doubt. For income investors, this is the point of maximum pain, maximum fear.
And that's where the psychology gets really tough for an investor, doesn't it? Maybe you bought it low at that 20% of book value, but then the dividend, the whole reason you probably bought a utility in the first place, just vanishes.
Precisely. This is where the weak hands fold, as they say. They sell out. often near the bottom. Because even though management is taking concrete steps like cutting costs, the stock price usually doesn't bounce back right away. Fear is still the dominant emotion.
So if you're buying in stage 2, you're betting the austerity works and regulators will eventually play ball.
You're betting that the combination of the company tightening its belt and the sheer necessity of its service will eventually force the regulator's hand. You're betting on forced cooperation, essentially.
And we sometimes see companies try to, well, erase the memory of the disaster, like changing their name.
Oh, definitely. Consumers Power is a classic example. They had that massive $4 billion write-off on the Midland nuclear plant failure. What did they do? Change their name to CMS Energy. It's like trying to use corporate whiteout, hoping the public and maybe the market forgets the scale of the fiasco.
A fresh start, symbolically at least.
It shows you the level of desperation and maybe shame involved. But let's go back to that core assumption. Survival. We assume they survive because it's essential, but could regulators just say no? Could they refuse to help, making this whole recovery bet invalid?
That is the ultimate risk. If regulators drew a hard line, no rate relief ever, make the company absorb 100% of the losses, yes, that company could fail. But regulators know letting a utility serving millions collapse creates a huge mess. Someone else has to step in immediately. And that's usually way more complicated and potentially even more costly for consumers in the long run than finding a way to help the existing crippled company slowly recover.
So the odds favor survival, but it's a painful, expensive kind of survival.
Right. So let's say management cuts costs successfully. They weather the dividend crisis. What's the first real sign things are stabilizing? That brings us to stage 3. Financial stabilization. The quiet recovery, you called it.
Internally, the big shift is that management has cut costs so deeply that the utility can actually operate day to day just on the cash coming in from current customer bills. They've achieved a sort of basic operational solvency.
They can keep the lights on without borrowing more money.
Essentially, yes. They're proving, quarter by quarter, they can manage the remaining operations, pay for fuel, keep things running without needing constant emergency infusions of cash. They're no longer on the immediate of collapse.
But they're still pretty constrained, aren't they? Not exactly healthy.
Oh, not at all. The big lenders, the capital markets banks, institutional investors, they're still very wary. They aren't willing to lend the utility money for any new projects or major expansions. And critically, the company still isn't really earning anything significant for its shareholders. Not yet. Survival is still the name of the game.
Okay, but for that investor who is brave enough, or maybe crazy enough, to buy back in stage 1 or 2, they're already seeing some reward by this point.
Absolutely. This is where the early patience starts paying off. The stock price has usually recovered quite a bit, maybe not all the way back, but those who bought during the peak panic, say at 20–30% of book, might have already doubled their money as the stock climbs back towards maybe 50 or even 70% of book value.
Why? What changes externally to allow that recovery?
Because the immediate existential threat, the threat of bankruptcy, has faded. The market starts to believe, okay, maybe they will survive this.
And this quiet recovery you mentioned hinges on a couple of key external factors finally turning positive.
2 main things. First, you need some sign that the capital markets are sawing, just a little. Even if they won't fund big new things, they at least need to stop actively freezing the utility out of basic financing needs. Second, and this is the big one, you need signs of eventual support, or at least non-opposition, from the regulators.
Meaning the regulators start letting them recover some costs.
Exactly. They start allowing the utility to gradually pass along some of the operational costs, maybe some of the restructuring costs, through slightly higher but still manageable rates for customers. That's the signal that the regulatory path to eventual financial health is opening up. It's essential for stabilizing the balance sheet long term.
Okay, so stabilization is achieved, the path forward looks clearer.
Yeah.
It finally gets us to stage 4, recovery at last. This is where the really big payoff happens.
This is the goal line. Stage 4 is defined by one key thing. The utility is finally actually capable of earning a real profit for its shareholders again. Wall Street, which had probably written the company off years ago, starts to see a positive future, and the big signal here, the dividend. It's either about to be reinstated or it already has been.
The return of the dividend. That's the ultimate sign of confidence.
It truly is. It says the company is stable enough and profitable enough to start returning cash to its owners, and the core outcome for the stock. Shares are now trading back near, or sometimes even above, book value.
So those patient investors, the ones who held on through all the fear and uncertainty,
They're the ones who reap the rewards. The doomsayers were proven wrong. And the profits can be substantial. In pretty much every case we've looked at, waiting through all 4 stages paid off massively. Doubled, tripled, quadrupled your money, often within about 5 years from the absolute bottom.
Let's revisit that CMS Energy example, the old consumer's power, because that really highlights the potential, doesn't it?
It's the poster child, really. Remember, they had that $4 billion write-off for the Midland nuclear plant. Huge disaster. The stock bottomed out in October 1984, right after they cut the dividend. Hit about $4.50 a share. It had been trading up in the $20 before the crisis.
So, truly crushed.
Utterly. But then, the turnaround. It was smart, strategic. They didn't just sit there. They actually converted that failed nuclear plant site into a natural gas facility, a completely different kind of power generation.
Interesting. So they repurposed the asset.
Exactly. And it worked. Fast forward 5 years from that $4.50 bottom, the market completely changed its view. The company was stable, profitable again, running on natural gas. That stock, it climbed all the way back up to $36 a share.
$36 from $4.50.
Yep. That's a 9-fold gain, 9 times your money if you bought at the bottom and held through the recovery. It just perfectly illustrates the potential power of buying an essential service provider when a specific, albeit massive, regulatory disaster makes its stock seem almost worthless for a time.
So the 4 stages really do give you a roadmap to potentially capture that kind of incredible rebound.
That's the idea. And if you boil down the strategy, it's actually pretty simple on paper. You look for these situations, buy the troubled utility when its stock hits that rock bottom valuation, say 20–30% of book, usually during the panic of stage 1 or 2. Then you hold. You hold until the dividend comes back and the company is trading closer to its actual book value in stage 4. Simple on paper, but that psychological difficulty you mentioned, that whiteout moment, that's the hard part, isn't it? Having the guts, not just to buy when everything looks terrible and they kill a dividend, but also having the discipline to hold through stage 3, that quiet recovery phase. Remember, you might have already doubled your money by then. It's incredibly tempting to sell and lock in that gain.
Right, which leads to maybe a final thought for you, our listener, to chew on. If a stock tanks to $4 and you buy it, and then it climbs back to $8, a lot of people sell right there. Hey, 100% gain. Not bad.
Feels great in the moment.
But as we saw with CMS Energy going to $36, selling at $8 means you left, 80 or 90% of the potential profit on the table. So the question is, does a true recovery investment strategy require more than just buying low? Does it require the extraordinary patience to ride that entire wave, maybe for years, until the dividend is back and the stock reflects full value? Are you disciplined enough to aim for the 9-fold game, not just the quick double?
It's really a question about your own temperament, your own patience limits, versus taking that immediate gratification. Something to think about.
Definitely something to ponder. And that's our deep dive for today. Hopefully this 4-stage map gives you a framework for separating genuine opportunity from just raw panic the next time a big regulatory disaster hits the headlines. Welcome back to the deep dive. Today we're tackling something, well, kind of intriguing, what some folks have called Uncle Sam's garage sale.
Right.
Our goal here is to really dig into how government privatization, selling off public stuff like phone companies or railways, turned into such a consistently profitable, almost guaranteed investment play globally.
It's fascinating when you break it down. Privatization, at its heart, is taking something the public owns, moving it into private hands, and often, crucially, selling shares back to the public. And our sources, well, they consistently show these deals were often structured to be, frankly, a very good deal for the buyers.
Yeah, the source material points to Britain in 1983 as a starting point. And they didn't get it right immediately, did they?
No, not at all. There were early stumbles. Brit oil, for instance, was seen as overpriced, caused a bit of a backlash. But they learned quickly. The sales that followed were, let's say, engineered for success. British Telecom is the famous one.
Doubled on day one.
Doubled in price on the very first day of trading. It was huge.
Wow. Okay, so how did they guarantee that kind of success? It can't just be luck.
Not at all. And this gets to a core finding in the sources. Politicians consistently structured these deals to leave a lot of profit on the table for the buyer.
So deliberately underpriced.
You could say that, or maybe politically priced. It wasn't really about market efficiency. It was a political strategy. They needed mass participation.
To make it popular.
Exactly. To get buy-in and quiet down the critics who, weren't happy about selling off state assets.
Right, right. And here's where it gets really interesting, mechanically speaking. They didn't even need all the money up front.
Precisely. That's the partial paid shares mechanism. It was basically an installment plan for buying stock.
An installment plan for shares.
Yeah. Take British Telecom again. The share might have a total price, let's say, equivalent to $30, but the buyer, they might only put down $6 initially.
Just $6 down.
Right. Then, if the share price, say, jumps to $36 pretty quickly, which it did, your initial $6 cash outlay has effectively multiplied 6 times.
Wow, that's incredible leverage.
It really is. And they used this exact same tactic for privatizing the big water companies, too. It just fueled this massive buying frenzy, guaranteed the offerings were snapped up.
And this idea, this mechanism, it didn't stay just in the UK, obviously.
Oh, no, it spread fast.
Yeah.
Looking at the bigger picture, by 1990, the sources say the total value of these privatized companies sold worldwide was over $200 billion.
$200 billion.
Shareholders everywhere were making returns the sources call, well, once in a lifetime.
And where was the biggest action?
A lot of it was in developing countries, especially their telephone companies. Think about it. Massive potential for growth.
Right. Huge untapped market.
Exactly. Growth rates were hitting 20, even 30% a year in some cases.
That's explosive. Any specific examples jump out?
Oh, yeah. The most dramatic one in the sources, Philippine long distance. Between 1990 and 1992, its value increased by, get this, 565%.
565%.
Yep. And even in a more established market like Hong Kong Telecom still saw 72.3% growth in that same period. Still very strong.
Amazing returns, just from selling off infrastructure that already existed. What about here in the U.S.? Did we see the same thing?
We did, yeah. The big one mentioned is Conrail, the Consolidated Rail Corporation.
Conrail, right.
The government had absorbed something like $7 billion in debt it had run up. Then they sold it off for $1.6 billion.
Okay, so a huge loss absorbed by the government first.
Correct. And the initial share price, $10. Later on, that same share was worth $46.
So again, why sell it so cheap after taking that huge debt hit?
It seems to circle right back to that political strategy we saw in the UK. Take the loss, offload the problem asset, but make absolutely sure the IPO is a roaring success. Makes the whole policy look good.
It makes sense politically. And while this main privatization was happening, other players were finding ways to profit too, right? Like from the cleanup efforts.
Yeah, the sources mention firms like Allied Capital too. They sort of capitalized on the side effects.
Oh, so?
Well, like buying up branches of failed savings and loans, the S&Ls, you remember that mess?
Oh, yeah.
Or providing financing to smaller companies, maybe borrowing at 8% and lending out at 10%. Basically finding opportunities in the broader government effort to sort things out.
I see. Okay, so let's distill this down. What's the big takeaway for you listening?
I think it's pretty clear. Throughout the 80s and 90s, when politicians decided to sell public assets, water, phones, railways, you name it, the way they did it, consistently created these massive, often almost guaranteed financial wins for the shareholders who got in early.
A kind of government-sponsored wealth creation machine built on selling things off.
You could put it that way, yeah.
Okay, so given that our sources suggest this trend of privatization might actually speed up because of ongoing government deficits, here's a final thought for you to chew on. If this keeps going, what other major public assets might eventually hit the auction block? Could you imagine, say, the Kennedy Space Center, or the White House Rose Garden, or even something huge like the TVA, the Tennessee Valley Authority?
It's a provocative question.
Definitely something to think about as you consider where public assets and private markets might intersect next. Okay, let's jump into this deep dive. We've got some fascinating listener sources today, really detailing an incredible 15-year story for Fannie Mae.
That's the Federal National Mortgage Association, for anyone needing the full name.
Right. And our mission here is really to trace how it went from, well, almost failing to hitting massive success between about 1977 and 1992, all through an investor's diary, which is quite a unique view.
It really is. And Fannie Mae itself is, it's kind of a unique entity, isn't it? Started by the government back in 38, then privatized in 68.
The ultimate savings and loan, someone called it.
Exactly. But the core question here, the hook, is the sheer volatility. I mean, how does a stock plummet to just $2 a share in 1981, a real historic low?
Yeah, $2.
Yeah. And then barely a decade later, 1992, they're posting record earnings, and the stock's trading up at, what, $68.75?
That's a wild ride, especially for long-term holders. So what caused that near collapse in the first place? What was wrong with their model back in the 70s?
It seemed smart at the time, I think. The basic strategy was borrow short and lend long.
Okay, what does that mean exactly?
Well, they'd borrow money using short-term debt, where rates were generally lower, and use that cash to buy long-term mortgages that paid higher fixed rates over many years.
Ah, so pocketing the difference. Sounds good if rates are stable or falling.
Precisely. It worked beautifully until it didn't.
Until inflation kicked in hard in the early 80s.
Exactly right. Suddenly, those short-term rates they needed to borrow at, they just exploded. We're talking 18, even 20%.
Ouch.
Yeah. But the income side, their mortgage portfolio, that was all locked in at those older, lower fixed rates. So they were paying out way more than they were taking in.
Just hemorrhaging cash.
Absolutely. And that's when the stock tanked. It had been around $9 back in '74, then just crashed down to that $2 low point in 1981, near disaster.
So how do you pull out of that kind of nosedive when your whole model is basically broken by rising rates?
Well, it took a major shift, a real change in, let's say, corporate personality. In 1982, a new CEO, David Maxwell, came in,
Okay.
and he essentially decided Fannie Mae needed to stop trying to be the market, holding all that interest rate risk, and instead pivot to servicing the market
Servicing it how?
by basically copying Freddie Mac, its sibling rival. The big innovation was packaging mortgages together, bundling them up.
Into mortgage-backed securities, MBS.
That's the one, MBS. It sounds technical, but the concept changed everything for them.
So wait, they just looked over Freddie Mac and said, let's do that. And how did MBS change the business?
Pretty much, yeah. Instead of holding thousands of individual risky mortgages for decades, Fannie Mae would buy them from banks, package them into these large MBS pools,
Okay.
and then sell those securities immediately to investors like pension funds or insurance companies. Fannie Mae just took a fee for originating and guaranteeing the package.
Ah, so they became like a packaging factory.
Yeah.
Less holding risk,
Hmm.
more processing fees.
Exactly. A high-volume, fee-based business. It drastically reduced their direct exposure to those wild swings in interest rates.
And the market saw this coming because the stock bounced back fast.
Oh, yeah. That $2 stock, it quadrupled in 1982 alone. Investors clearly anticipated this shift could lead to a golden age for Fannie Mae.
But hang on, selling off new risk is one thing. What about all the old low-rate mortgages still sitting on their books from before? That risk didn't just vanish, did it?
No, you're right, it didn't. And that's where the next phase, the long-term risk management strategy, came in. Starting around 1983, they adopted what they called the block of granite approach.
Block of granite. Sounds solid.
It meant a serious commitment to duration matching, basically making sure the effective lifespan of their assets, the mortgages they held, matched the lifespan of their liabilities, the debt they used to fund them.
So no more borrowing super short-term to fund 30-year mortgages.
Much, much less of it. They learned the hard way from '81. This matching was designed specifically to insulate them from those sudden spikes in short-term rates.
And that resilience got tested pretty quickly, didn't it? There was the '87 market crash.
Yep, the Great Correction. The stock took a hit, dropped back to around $8 temporarily.
And didn't they have issues like foreclosures in Texas around then, the oil slump?
They did. Regional shocks like that happened. But because their core business was now more about packaging and managing duration risk, they could weather those storms much better than the old Fannie Mae could have.
So they stuck with the plan. Package, manage risk, collect fees.
And they got really sophisticated with financial tools to control their costs, too. One key thing mentioned in the source material is their use of callable debt.
Callable debt, right. Explain that simply. How did that help?
It's basically debt they issue, so borrowing money, but with an option built in for them to pay it back early.
Ah, so if interest rates go down after they borrow.
Exactly. If rates fell, they could call back the old expensive debt and issue new debt at the cheaper rate. It gave them huge flexibility to constantly minimize their borrowing costs, locking in more profit.
Clever. So better risk management, smart cost control.
Tighter standards, focus on fees. It all added up. The growth became, phenomenal.
And the payoff by 1992.
Record earnings. Over $1 billion, $1.1 billion. And that investor who held on from the dark days, their stock was sitting at $68.75.
Incredible turnaround. It really underscores that point from the investor's diary, doesn't it?
It absolutely does. The note basically says you can't just rely on the current popular opinion, good or bad. You have to keep checking, keep reevaluating because, quote, the story keeps changing.
A company can fix a fundamental flaw. It can reinvent itself.
If it's willing to make drastic changes to its whole model, yes.
So this whole 15-year saga shows Fannie Mae mastering rate risk, using new tools like callable debt, rebuilding itself, Given they got so good at handling that kind of external risk, what kind of challenge, maybe internal, maybe a different kind of external shock, do you think might test them next down the road? Something for you, our listener, to consider. Okay, so today we're doing a deep dive into something pretty interesting. The mutual fund industry back in the late 80s, early 90s.
Yeah, specifically looking at some, well, massive performance gains that a lot of people on Wall Street just completely overlooked at the time.
It really seems like a major miss, and our sources point to this period right after the '87 market correction.
Exactly. There was this cloud of pessimism, a kind of generalized fear that really blinded investors to what was actually happening structurally.
Which brings us to this core idea, this analogy. The sources use the gold rush strategy.
Uh-huh. The old saying, right? During a gold rush, sell shovels.
Right. Don't be the prospector digging for gold. Invest in the companies selling the picks and shovels. And in this case...
The shovel sellers were the mutual fund companies themselves.
Yeah.
Dreyfus, T. Rowe Price, Colonial, those types.
And the sources say the failure to see this was huge. Like if you just put money into a handful of these fund company stocks.
Yeah, the what if is pretty stark. An equal portfolio across maybe 8 of these stocks, starting in 88 or 89. It would have beaten like 99% of the actual mutual funds being pushed at the time.
Wow. Okay, so why? What made these companies, the shovel sellers, such reliable cash cows back then?
Well, it really boils down to interest rates. When rates started declining, where did money flow?
Into bonds, into stocks,
Right.
into mutual funds holding them.
Precisely. So bond and equity funds saw huge inflows. And companies heavy in those areas, like Eaton Vance, Colonial, they manage more assets, they make more money. It's assets under management, AUM.
So falling rates were actually a good thing for their business model, even if the market felt scary.
A huge structural tailwind, more assets mean more fees, pretty straightforward, even with all the doom and gloom talk.
Which is wild because you hear about industry collapse rumors, but then 1991 hits and boom.
Yeah, the rebound was dramatic. T. Rowe Price shot up, what was it, 116%?
Incredible.
United Asset Management, 80%. Dreyfus, 75%. It just showed the underlying business was solid despite the bad sentiment.
But even with those massive 91 gains, were there still pockets of value? Did the market still not fully get it?
Absolutely not, according to the sources. Take Colonial Group. Managed $5, maybe $6 billion, appreciated 40% in 91, which is great, but it was still only trading for about 10 times earnings.
10 times compared to...
Well, T. Rowe Price was trading closer to 20 times earnings around then. So Colonial looked, comparatively cheap, basically half price for a similar kind of financial engine.
Okay, that's undervaluation.
Yeah.
But then there's another angle, the plumbing of the system, the back office.
Right, State Street Bank. They weren't picking stocks or managing funds directly.
They were just handling the paperwork, the record-keeping, customer service, all that stuff.
Exactly. The essential nuts and bolts infrastructure for a huge chunk of the industry. And guess what?
Let me guess, their stock did well too.
Extremely well. An 81% gain in 1991. It just proves that sometimes the most boring essential service is where the reliable profit is, providing the infrastructure everyone else needs.
And State Street did something pretty smart strategically. They launched their own funds, but they hired Colonial Group to actually market them. Why not just do it themselves? Why the camouflage?
Well, think about who State Street's main clients were.
All the other big mutual fund companies.
Yeah.
The ones they did the back office work for.
Exactly. If State Street suddenly became a huge direct competitor launching a massive marketing campaign under their own name, well, you risked alienating your core high-margin clientele.
Ah, so they outsourced the marketing to Colonial to sort of keep it at arm's length, avoid biting the hand that feeds you.
Pretty much. A calculated move to enter the fund space without jeopardizing their lucrative core business. Smart risk management.
So, wrapping this up, the big takeaway seems to be sometimes the best investments aren't the flashy ones, the funds everyone's talking about.
Right. It's often in the support structure, the backyard stocks, the essential services, like Colonial's hidden value or State Street just efficiently running the operational side, the shovels, or even the company making the handles for the shovels.
It makes sense. Find the essential, maybe less glamorous part of the boom.
Precisely. And it leaves you with a thought, doesn't it? If that back office infrastructure, the simple record keeping by State Street, was that crucial and profitable back then, given how much more complex and massive the financial world is today, just how much more integrated, essential, and frankly indispensable is that hidden infrastructure now? Something to think about.
Welcome to the deep dive. Today we're digging into something pretty fascinating, the huge boom in restaurant stocks, mostly from the 60s up to the early 90s.
Yeah, we've looked at sources showing how these simple food joints turned into absolutely massive investment plays, but they were often totally ignored at first.
Right, and our mission here is to pull out the key lessons, from these investments where people literally put their money where their mouth was.
It's funny because back in the 60s, Wall Street basically scoffed at them. They were all about the Nifty 50, those big blue chip
Yeah,
stocks.
the established giants.
Exactly. And they totally missed that fast food was becoming, well, essential part of the whole car culture that was exploding across America.
It really is wild. They were chasing glamour stocks, I suppose, while the real money was being made in, like, burgers and chicken done efficiently.
The numbers are just, well, staggering. Take Shoney's. It was a 168 bagger. Think about that. Your money multiplying 168 times.
Wow.
And Bob Evans Farms, an 83 bagger. And the king, McDonald's,
A 400 bagger?
400 times. Get this. If you'd put just $10,000 into 5 of the main players back in the late 80s, you could have become a millionaire 4 times over.
Oh, it's just incredible. So, okay, what made the difference? How did some become 400 baggers while others just, fizzled out? Maybe start with an origin story. KFC comes to mind.
Kentucky Fried Chicken, a great example. What's really key isn't just Colonel Sanders' story, though it's memorable. It's his model.
The royalties, right?
Precisely. In 1966, he's 66, facing bankruptcy. But he realized the gold wasn't just selling chicken, it was selling the recipe for royalties. A few cents per piece.
That's genius.
It really was. KFC became a 40-bagger even before PepsiCo bought them. It proved scaling the system, not just the stores, was the way to serious wealth.
Okay, so that's the potential. But the sources really drill down on one thing that separated winners from losers long-term: pace, how fast they grew.
Oh, absolutely critical. You've got this perfect comparison. Fuddruckers versus Chili's.
Right, Fuddruckers, they kind of blew up, didn't they?
They did. They expanded way, way too fast. Opening over 100 new restaurants a year. Just breakneck speed.
And that caused problems.
Massive problems. Management couldn't cope. Training suffered. They picked bad locations. Quality just went downhill everywhere. They were chasing growth, not quality. A classic mistake.
Okay, so compare that to Chili's.
Chili's under Brinker International was the opposite. Super disciplined. They added maybe 30, 35 new spots a year. Slow, steady, controlled.
Allowed them to keep things consistent.
Exactly. And that discipline let them build towards, a projected $1 billion in sales by the late 90s. Stability won out over speed.
So the investment rules that came out of this were
Pretty clear, actually. You need growth, yes, but disciplined growth. Keep debt low. And crucially, watch those same-store sales.
same-store sales. Why is that so important?
Because it shows the existing stores are getting more popular, more efficient. It means your profit isn't just coming from the cost and risk of opening new places. The core brand is healthy.
Gotcha. Okay, connecting this forward. By the early 90s, things started shifting again, right? The market changed.
Yeah, the baby boomers who fueled that initial fast food wave, they were getting older. They started wanting maybe better quality, more specialized food, a nicer place to sit down.
So not just quick burgers anymore.
Right. And that opened the door for all these niche restaurants. Suddenly, it wasn't about the generic chains. It was about specialty concepts, like Au Bon Pain with its, fancier croissants and coffee.
In places like Spaghetti Warehouse.
Exactly. Those medium-priced family spots became the new growth engines.
Which leads us to that famous 1991 hot list. Montgomery Securities picked 8 stocks they thought could double by year end.
That's the one.
Okay.
Included names like Cracker Barrel, Applebee's, Outback Steakhouse. Big winners eventually.
But there was a catch, wasn't there? Valuations.
Oh yeah, the sources warned they were really expensive, PE ratios of 30 or even higher.
Meaning people were paying a lot for future growth.
A lot. But the thinking was it was worth paying up because these companies had really strong management teams and solid finances. The market was learning execution deserved a premium.
Okay, so let's wrap this up. What's the big takeaway for someone listening today?
I think it's that finding success in this sector wasn't just about high margins or low costs on paper. It was about spotting management teams that were stable, disciplined, and had a growth plan that made sense, one they could actually execute without stumbling. Controlled growth is key.
Right. Discipline over just raw speed.
Which leads to a question for you listening now. Americans eat half their meals out these days. If you're that observant miner, Where's the next potential 20-bagger hiding in plain sight in your town?
Yeah, think about that. What's the modern equivalent of Aubon Payne's croissant idea from back then? What current niche, what food concept
Hmm.
has that potential for steady long-term growth, maybe even overseas, but hasn't, overplayed its hand yet? That's the challenge. Something to chew on. Thanks for joining our deep dive today.
Welcome to the deep dive. Today, we're digging into something really crucial for any investor, the 6-month financial checkup.
That's right. It's more than just, glancing at stock prices.
Definitely. We're talking about really understanding the company's story.
Exactly. Two core questions you have to ask. Is this stock still a good value based on its earnings?
And, maybe more importantly, what's actually happening inside that company.
Right, because the whole buy and forget idea, it can be dangerous.
Yeah, really dangerous. Think about some of the giants, IBM, Sears, Kodak even.
Mm-hmm. They looked okay on the surface for a long time, but then their price to earnings, the PE ratio.
It just collapsed. Didn't come back.
And staying on top of that is why this checkup matters. There's a real reward.
We saw that in the example portfolio you tracked,
Yeah.
right? January to July 92.
Yeah, sample 21 stock portfolio. Over just 6 months, it returned, get this, 19.2%.
Wow, 19.2. And what did the S&P 500 do then?
Just 1.64%.
Okay, so that difference, that's the value of actually doing the work, of doing this checkup.
Precisely. And when you do this checkup, you basically end up in one of three places.
Right. The story got better, it got worse.
Or, it's pretty much stayed the same.
Let's talk about when the story seems worse first. That sounds counterintuitive.
It can be. Take the Body Shop back then.
Right.
Wonderful company, but maybe a bit overpriced initially.
And the stock price reflected that.
It did. It dropped about 12.3% in those 6 months. Lots of bad press, too.
I remember something about an issue with an indigenous supplier.
Yeah, the arrest of a Kayapo Indian chief they'd hired, plus shareholders selling off. The story looked worse.
Okay, so bad headlines, stocks down. Most people would run, right? How is that not a sell signal?
Because you look deeper. The fundamentals were actually still good. Same-store sales, up. Earnings, up.
Ah, okay.
And here's the key insight. They were using cash to buy up inventory from suppliers.
Which means?
Better profit margins down the road. So the bad story was actually, maybe, a temporary discount.
Got it. A disconnect between the noise and the actual business health. Okay, let's flip it. What about when the story gets better? Like Pier 1 imports.
Right, Pier 1, that was a clear success story during that period. Stock went from about $8 to $9.50.
Yes, run. What was driving that?
Good management moves. They paid down debt using proceeds from some convertible bonds. Smart.
Okay. Cleaning up the balance sheet.
Exactly. And they cut costs, kept expanding. Then they posted earnings of 17 cents a share for the quarter.
So tangible proof things were improving. The story matched the number.
That's it. It showed real financial health improvement.
And this checkup isn't just about individual stocks, is it? You've got to look at the bigger picture, too.
Absolutely. Like the cyclicals and the S&Ls, the savings and loans back then, the whole environment was improving for them.
Yeah, we saw some big jumps there. Sovereign Bancorp was up, what, over 60%?
64.5%, yeah. Germantown Savings started paying a dividend, up 26%. Signs of recovery.
But the real high-stakes play was in the auto sector, wasn't it? Chrysler.
Oh, yeah. GM did well, up 37%. Solid. But Chrysler was the big opportunity and the big risk.
Because it was really struggling, right? Stock was low 20s.
Around $21, $22. But here's the thing. People doing their homework saw potential earnings, if the turnaround worked, of maybe $5, $6, even $7 a share.
Huge potential upside. But you really had to believe in the turnaround. What were the signs?
New models coming. The Jeep Cherokee update, the new LH cars, people were excited about
That
those.
product pipeline looked good.
And they were managing their debt. It took nerve, but the checkup showed the potential was there, even if the present looked tough.
And that bet paid off.
Big time. The stock doubled in 1992. That conviction, based on the checkup, was rewarded.
So bringing it all back home for the listener, this 6-month checkup, it's really about discipline, isn't it?
It's entirely about discipline.
Yeah.
Knowing what you own. Knowing why you own it. What's the real story?
Not just following the herd.
Especially not following the herd. Which leads to, maybe, a final thought here, sort of a golden rule.
Okay, let's hear it.
In today's market, which is so dominated by, this herd of professional investors,
Right.
the disciplined amateur, the person who actually takes the time to study the companies, the industries, to apply real knowledge, every 6 months.
They have an edge.
They have a huge inherent advantage. That's how you can find success.